just to see you. Whoa, we're safe inside. You make things right. Don't wait up. I'm okay, making time tonight just to see you. No, we're safe inside. You make things fine, so don't wait up. I'm okay, making time.
Private markets have become a defining feature of global finance.
I see a couple of people doing some dumb things.
AI is going to be so disruptive that it renders countless businesses obsolete.
I sincerely believe there is no bubble in the AI space.
We are in the midst of a rupture, not a transition.
We call him too late. He's too late. Jerome, too late, pal. He's too late.
Please welcome to the stage Bloomberg's Lisa Abramowitz.
Hello, good morning. Welcome to day two at Bloomberg Invest, a conference that increasingly is focused on the most important topic of the moment, aside from oil prices and what's going on in the Middle East, which is private credit. And we do want to focus and sharpen our focus on private credit and private markets more broadly in day two of Bloomberg Invest. Before we get to it, we had some amazing conversations yesterday with Apollo's Mark Rowan, as well as with Soros Fund Management CEO Don Fitzpatrick. Today we have an incredible lineup for you. We do have a couple of housekeeping issues to get through. We're going to just acknowledge first our sponsors. First, title sponsor Invesco QQQ, our knowledge sponsor Marsh, our supporting sponsors Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce. And for those of you in person today, if you haven't already done this, please scan this QR code. This code will take you to a landing page where you can find our Wi-Fi information toward the top, plan your agenda today with the community, and of course, you can, of course, also submit questions to our speakers. We will try to integrate them into the conversations as we can. If you have any issues whatsoever, we, of course, have a help desk. You can please feel free to go discuss with them. You can find more information on our sponsors here. And if you don't already, please subscribe to Bloomberg.com and all our global finance coverage. Today is your lucky day if you want to do so, because you can get a discounted subscription. And if you are active on social media, use hashtag BloombergInvest in your posts. And you can follow along with all of our coverage at Bloomberg Live on all of the major platforms. Please also, lastly, silence your phones, as we do have an incredible lineup, which I want to say starts off with someone who is one of the behemoths in private markets, one of the behemoths, frankly, in world investing. I want to welcome to the stage someone who has really shaped the way that private investing has taken shape over the past 15 years. It is the Temasek Holding CEO, Dilhan Pillay.
Thank you. Morning. Thank you.
As I said, this is a massive fund. As of the fiscal year that ended last March, so I'm not going to say what happened for this year, they have $340 billion of assets under management. Dilhan Pillay has overseen this fund as it has changed pretty significantly from back in 2011, primarily being an investor in Singapore assets. Today being very different. Could you just, before we get into some of the current events and what's been going on in markets, just give us a sense of that transformation that you've seen?
So actually the transformation done by my predecessor, Hsin, and she was brought into Temasek to make us more of a global investor. When she first came on board, 97% of our assets were Singaporean companies. And by the way, we own our assets, we don't manage it for anyone. By 2011, we had made it such as about, something like about 56%. And today, Singapore assets are just 41% of our total net asset value. And so that transformation that's been done over the last, I would say, 20 years has been predicated on investing in global markets. We first started in Asia in the first decade of the 2000s, and then in the second decade, more into the US and Europe, because we felt that a balance between developed markets and emerging markets was required. We also started to increase our allocation into funds and asset management platforms that we set up. And so today, we have a fairly balanced portfolio, which is 41% the Singapore companies that we control, roughly about $150 billion of revenue that's either consolidated with a balance sheet or of companies that we control with significant minority stakes. 30% is in global investments all over the world. And the balance of 23% is in funds, asset management companies, and partnerships that we have with either financial institutions or corporates. So it's fairly balanced, I would say.
And you were speaking before, and you were saying about half of the fund is liquid, and half of the fund is illiquid in private markets.
Yeah.
As we sit here today, the world feels very dynamic.
Yeah.
We were thinking about AI disruption. Now we're thinking about an oil shock that could potentially send inflation spiraling. As someone who tries to toggle between private and public, liquid and illiquid, how do you think about catalysts that seem to be coming at us increasingly frequently?
Yeah, that's a good question. So if I were to go back to 2011, we were 80% liquid, 20% illiquid. By the end of the decade, we were sort of like 55% illiquid, 45% liquid. Today, we're about half and half. So 50% is in liquid, 50% is not liquid. If you look at this chart here, you will find that we're primarily an equities house. So you take away the private credit at 2%, core plus infrastructure at 1%, 97% is in equities. And it's 48% liquid and 49% illiquid. So it's a balanced portfolio. Now, why is it that we went into private markets? In a low interest rate environment in the past decade, you could actually argue that you could earn the illiquidity premium within a reasonable time frame. So in the previous decade, time to monetization through public markets within 5 years, if then went to 8 years. Today, you're looking at past even a decade. So the question for us today is whether you will get the illiquidity premium in a higher interest rate environment. So that's why we've decided to put a little bit more capital into liquid strategies. That includes public markets, investing indices, and things like that. Because we feel that in a world where there are more surprises, shocks coming more frequently, disruptions like AI this time around, it is important to have enough liquidity to be able to pivot, change strategies, pivot, decide where you're going to put your chips for the longer term, or even rebalance for the shorter term. And so as a result of that, we've decided that we should maintain a certain level of liquidity in our portfolio, because we do think there's a premium in being liquid today. That's our view.
So, and I want to get into just how much you are planning to continue to increase the liquid versus the illiquid part of your portfolio. I mean, is that significant in terms of how much more you have to go?
No, I think we're there. I think for now, for every dollar we invest, we're not going to do it in a programmatic way, but I think it would end up being sort of 50-50. You know, some years that may be a little bit more because of opportunity, some years a little bit less, but we'll make sure in the long run we maintain that balance.
We'll get into the private side of things, but before we leave this, I want to get your thoughts then on how you respond and be dynamic in the face of a potential oil shock, since that's the latest catalyst, in addition to AI disruption and credit fears, that seems to be targeting investors. Do you respond to that? Does it make you pivot?
You know, things like oil shocks, we've had to live with it for a long time, and parts of our portfolio will be impacted by it. For example, we own an airline. By the way, for those of you who fly regularly, please consider our airline. You know, whenever you have something like this, like what's going on in the Middle East, straight away, even though the Middle East is a small portion of the revenues, people think about the potential of increased oil prices on your P&L. People might travel less because of conflict and things like that. Every time there's something like the avian flu, your airline gets impacted by share price, so everything gets impacted if you own an airline. Like, look, you know, some parts of our portfolio clearly will be impacted by rising oil prices. You know, power generation companies which have inputs from natural gas and things like that. But the bulk of our portfolio is not. It's quite inoculated from the impact of oil prices. Obviously, for the financial services sector, it's a proxy to the broader economy, so that part of it gets impacted. But we've got a fairly balanced portfolio. I'm less concerned.
When you talk about the 50% that is in private markets, I just wonder how much, you said 2% is in private credit, how closely you're watching what has percolated out that people see potentially deepening, really the epicenter right now, BDCs, private credit funds tied to software.
Yeah. So first of all, I would say that private credit is a relatively new part of our portfolio. You know, we've always been investing in it for the last, I would say, 20 years, but we started to ramp up about 10 years ago. So the 2% of our portfolio value, which is roughly about $7 billion US, it's really something that we built in the last 10 years. We have a separate entity, a credit hybrid solutions entity that we spun out as a wholly owned subsidiary. And that has a very clear mandate, you know, get us something like a 5 to 6% cash yield on an annual basis, a total return of maybe, you know, low double digits, 11 to 13% with a leverage cap and a cap on PIK because we want the cash yield. And with that mandate, they've managed to do quite well. The credit quality is keeping up. Besides that, we have investments in funds with people that we believe are best in class. You know, so far, they're holding up. So it's really a question of manager selection, the kind of the part of the credit sector that you want to put your money with, and then you take. You have to figure out whether, you know, the asset quality is there, whether the fund managers are doing what they're doing. And so far, you know, I'm not as concerned with our credit portfolio.
So there are two ways to ask this. First of all, it's only 2% of your portfolio, so it's pretty small. You address the one of how is your portfolio managing through this. The other way of saying this is, at what point do you get excited about where you can potentially expand and get involved if there is dislocation?
So that's always the exciting part, isn't it? Because if you can get in cheaper, that's the best way to make returns. You know, it's all a question of the entry-level price. So when there's a lot of froth in the market, you take on more risks. It's more expensive to get the returns that you want. So the question for us, you see, you still have to go back to the question of asset quality and the pricing for the asset quality, right? And so I think that there will be opportunities for us to partner with the funds that we are invested in to look at those opportunities at the right time. You know, you have to, it's opportunistic, okay? It's opportunistic. And it's not going to be a major part of our portfolio. We're still going to be equities focused, right? So maybe private credit can go up to 5% of our portfolio over the long run. But we don't want to change the DNA of the firm. You know, it's primarily equities firm. Now, why do we do private credit? Well, it's simple. It's a little bit of a diversifier from our equities exposure. It gets us up the capital stack compared to where we normally would be. But the most important thing is it gives you market signals of what could happen in the equities piece of your capital structure. You know, so that's what we look for.
What's the signal right now?
You know, certain asset classes or certain sectors that we're invested in, we've got to be very careful about looking at the balance sheets of those companies and what it means in this in this cycle today, and whether the cash flows they're underwriting are going to be strong enough, to withstand volatility or shocks in the system.
Shocks in the system is one thing. Disruption as a
Disruption
result
is a big
of the
part
new
of it.
technology. So
Yeah.
how do you identify who's prone to it, whether the software shock is really specific names that are going to go to zero and others that are going to be incredibly successful, or some kind of widespread replacement?
So I think, with what we've seen in the last few months, things that you didn't think would be disrupted are becoming disrupted, or at least the perception of disruption is very high. And so you now have to think about other things that you're investing in and what is the likelihood of disruption, because today the reality is that disruption may come sooner than you've expected before. And therefore, to what extent are companies prepared for that? Now, I would say the counterbalancing to AI disruption is AI adoption. So if you have companies that can adopt AI to accentuate their business models and be able to not just withstand the shock of disruption, but actually thrive in it, that's the most important thing that we look for. And that's what we're doing today through our portfolio.
Are there certain types of companies that seem like they are able to take advantage of this disruption versus just those that are looking to potentially survive through it?
Yeah, so look, even with software companies, right, which are in the news all the time, if you're mission critical and you know how to use it to actually accentuate your product offering, it's a good place to be in, because no matter what, we're still going to need software. It's not like AI is going to take over and the entire software sector is going to dissipate. But you've got to make sure you can pick the right companies to invest in. I think that AI is going to have a profound impact on sectors like, pharma, biotech, drug discovery, drug development. I think it's going to have a profound effect. And so those companies that partner with for AI solutions are going to be a beneficiary. The question is just when. It's also a highly regulated sector, so a lot of things have to happen for you to see the full benefit of AI adoption.
So you're talking about how things are pretty dynamic, and these are things you can't know right away. And so that's one of the reasons why you want to have a bigger proportion of your portfolio in liquid versus private companies or illiquid. Can you give us a sense of which companies you'd rather own in your liquid versus illiquid? Is there a certain type of asset class or a certain type of industry?
Yeah. So look, you got to, when you look at liquid, you got to figure out which part of your portfolio is really for the longer term, and that's compounding. So you got to look for companies that you feel can be compounded. Some of the Mag 7, you can take the view you can compound for a long period of time. If they keep innovating at the pace that they're innovating. There are other companies which we feel in the deep tech sector, etc., that could also be compounding. You look at where the choke points are and demand versus supply, and you can figure out that some of these companies could be companies owned for 10 years in the public markets. There is going to be more convergence between AI and climate adoption, climate tech adoption. Okay, and I think that that's what's going to help with climate change transition for many of us. And I think that that's exciting for us to look at and see which companies will be prime beneficiaries of that. So there are many different sectors where you can look at it differently now because of AI.
You talk about returns, and you've delivered some pretty significant returns investing in private markets over the years. And I just wonder, you expect bigger returns for taking bigger risk. And there are times that feel like a better time to take more risk and times when maybe not so much. How do you characterize the moment we're in right now?
So I think it's probably the most trying time to be a long-term investor. It really is, because if you're trying to invest for the long term, you're trying to invest through market cycles, and nowadays with the disruptive forces out there, what exactly is the cycle for your business model? Are you continually transforming your business model for that? And I think a lot of it depends on the industry, the company, the psyche of management, and things like that. Even we as a shareholder, an investor, pushing for companies to continue to always be on the edge of transformation. And I think that is the biggest issue for us, as a long-term investor. So if I look at what concerns us as a long-term investor, or what's on the horizon for us, first of all, is geopolitics. It does impact. Secondly, is geoeconomics. What happens for the US dollar does impact our returns, for example. The third would be technology. not just in disruption, but how they use technology to actually improve things, not just in business, but in the world. And finally, the investment strategies that take all these things into account. So, in that sense, 10 years ago, we didn't have to think so much about geopolitics. Geoeconomics are fairly stable. Technology disruption was identifiable. And then finally, your investment strategies are pretty much linear. Today, it doesn't happen that way anymore, I think.
So, talking about geopolitics, do you think that people are overly sanguine right now in markets about the geopolitical risks?
I think the market has taken a view that some shocks can be shorter in duration than otherwise, and so therefore they are pricing the risk, but they feel in the longer run, you might be able to get around the risk and still be all right. I'm not smart enough to know whether that's the right thing to do or not. I'll just watch and see where we put our funds to work. But I do think that there is a certain amount of, I think the market's relatively sanguine with everything that we're seeing. And let's face it, right? I mean, since what's been happening in the Middle East, the markets really haven't moved down that much. S&P is down, what, 1.5, 1.6%? Our financial year is 31st of March. What happened 2nd April last year? And you saw with the way market moved down. Thankfully, our financial year is 31st of March. Or thankfully the Liberation Day happened on 2nd April. Anyway, this time around, we've still got 27 days to go for our financial year to close. It's better to look out 5 months down the road because something had happened to turn it around. 27 days is interesting. So let's see. Yeah.
I want to finish up on dollar exposure because.
But can I just add something? You see, we're allowed by our shareholder, and shareholder doesn't get involved in our business at all, to take more risks because we're equities investor. So we're high on the risk. I would say on the risk curve, and our threshold for pain therefore has to be higher. And so the requirements for returns are therefore much more than what would be required of a sovereign wealth fund. So that puts you also a little bit more on edge, right? Because you have a responsibility of trying to deliver those outsized returns. And in inflation adjusted world where interest rates are higher and possibly higher for longer, we should expect to get those higher returns. So we have to put that on ourselves.
Yeah, so you notice some of the risks out there. I do want to finish up with the risk of the dollar because about half of your portfolio, I believe, is exposed to the dollar.
Directly 41%.
41%. So I'm just curious how you're hedging. Are you planning to reduce exposure to the dollar in order to avoid some of the fluctuations, or are you going to double down?
So the most trying time was the second quarter of last calendar year, when the dollar began to depreciate significantly against the Singapore dollar. And Singapore dollar is our reference currency. And in any event, 50% of our exposure is in Singapore dollars. So it moved, I think, almost 5 or 6% during that time. It's about 7% down year on year. But it went up a little bit in the last few days. So that just tells you that the dollar is truly, the currency you go into in times of risk. So what we tried to do then was we figured, okay, we'll hedge part of the dollar-denominated portfolio, which we did, a significant amount, I would say. And the cost was fair, was okay. But as we go along, everybody else had the same idea. People were not rotating out of US dollar-denominated assets, they were hedging for returns. And the hedging costs went up to, 2.5, 2.6%. So today, the cost of hedging doesn't make sense unless it's tactical for a shorter period of time. And so we now have to basically put in place what we will call natural hedges, which really means you have to invest in things that will give you a return that outpaces expected dollar depreciation. But, the events of the last few days reminds us that the US dollar is still, the global currency of choice, reserve. It's not just a reserve currency, it's a safe haven currency for many things that happen in geopolitics and what happens in the world. And so I think we've got a good balance, I would say. The dollar has strengthened. The policy of the Treasury Department is to have a strong dollar. So in that sense, would that change anything that we're doing? The answer is no. We'll continue to invest significantly in US and US dollar denominated assets.
Well, there is so much more that I want to ask you, but unfortunately we have run out of time. Dilhan Pillay of Temasek, thank you so much for being with us.
Thank you.
With our combined platform, we're better positioned than ever to be a high-grade solutions provider.
Please welcome to the stage Scott Kapnick, founding partner and CEO at HPS Investment Partners and chairman of the Private Financing Solutions Executive Office at BlackRock, for a conversation with Bloomberg's Jamie Berger.
Thank you all so much for joining us this morning. And Scott, thank you so much for sitting down with me.
Thank you. Good morning.
We're in a moment that feels very pivotal for this market. And I think it's useful to just take a beat because in many ways your career reflects the entire journey that this market has gone on. Heading up the investment bank at Goldman, spinning out HBS from JP Morgan, bringing that back under the fold of another company, BlackRock. Scott, how did we even get to this moment, though, where private credit became the behemoth, the headline grabber that it is today?
Right. Well, good morning, and thank you for having us. And you know, we're living in a moment right now where maybe one of the most significant events in the world for the last 50 years is happening while we're also talking about private credit. So it's a little bit hard to put that into perspective. But I think you know, what's from my perspective, again, 40 years in finance. Been all over the world with Goldman and JP, and you know, the Western capital markets are going through a real change and evolution now. As you've had sort of the post-financial crisis landscape really settle in, banks have shrunk. You've got some big banks still very involved in the capital markets. You've got some big, some of the people that were on stage here over the last couple of days. You know, insurance companies and others, and then you've got some fiduciary firms like ourselves and BlackRock and Ares was on stage. You know, those firms are really bringing private pools of capital to grow companies, and with that, there's not enough bank capital in the world to grow the economy, and particularly as governments have leveraged themselves, there's really just not enough capital to grow the economy, and I think you're going to see that. Wave has been very big in the U.S., very big in Europe, parts of Asia, Australia. I think that's going to continue over the next 30 to 50 years.
It's a good point because not only are governments very levered at the moment, there are these huge projects that they're undertaking, whether it be Europe wanting to be more self-reliant, be it the AI build-out in the United States. So just how critical of a pillar has private credit, has private capital become for these economies? Yeah,
I think that, you know, again, they're not, with the capital expenditure that's going into both technology, AI, as well as the underlying infrastructure, you're not going to be able to do that without private pools of capital. And Dilhan, who you just spoke to, is one of the smartest and most aggressive in that. And I think, you know, you've got to have people pull that together and help structure things in a way that optimize and make it efficient. You know, so you want equity in that. In order to attract foreign direct investment, you need the capital that comes alongside the equity to help that.
You made the comment to me the other day that I thought was interesting, that not only is this change continuing, but the pace is accelerating. What does that mean if we zoom out 5 years from now? If the pace continues to accelerate, what does this market look like?
Other than our heads explode?
Yeah, that's possible too.
No, I think that we are in a period where change is really evolving quickly, and I think that with what's coming with AI, and I know Larry Fink and Rob Goldstein wrote an article on tokenization and the impact of that. That's also going to change financial structure as well as technological evolution. So all of that is going to come here in the next few years. Most of the financial landscape was set up really after, 1929, 33, 34 Act. Banks in the U.S. and the West formed around those structures, and a lot of the technological change it has the potential to really change that dramatically.
Well, as we laid out, you've invested in many moments of disruption, be it Goldman at the dot-com boom and bust, be it JP Morgan and HPS during the financial crisis. This moment of change right now, does it compare to the scale of those disruptions?
I think one thing you learn is every disruption is different. I think a few of the things that you have to watch, again, I was in Germany in 1990, so the wall fell in 89, 90, and then as you get into the 1999 buildup for the dot-com and then into the financial crisis as with part of JP Morgan, leverage in the system, you have to watch that. We've been very conservative with leverage in what we're doing. I think, those are themes that come out. Matching assets and liabilities and matching structures so that you don't have a liquidity mismatch. I do think what's different today, the banks are I think, very healthy. You heard Jamie Dimon, you hear other bankers talk. I think the banks have remade themselves after the financial crisis. Obviously, we recapitalized the banks in the U.S. In Europe, they've shrunk a bit. But they're very healthy, so that's a positive sign. And then I think the CapEx cycle that you mentioned is something that has put the economy in pretty good shape here. So if we are going into a period of disruption, I think those two things are at least positive to keep.
So where do the concerns of leverage in the system come from then?
Well, I think that a lot of the leverage has moved to governments. So you've seen Scott Bessent and others try to really make sure that we're growing the economy and that the world is growing to keep pace with that. And then you've seen the labor dislocation that may come out of technology. We don't know where that'll go. That creates political upheaval and can rattle financial markets. Right now, I think the financial markets are behaving, some would say pretty surprisingly, how we're managing through what is a pretty significant turmoil, obviously, in the Middle East.
Jamie Dimon, though, you mentioned them. He did say, along with the health of JP Morgan, he's worried about others seeing risky lending that echoes back to pre-2008. Do you not see any of that then?
No, I would agree with that. I would say, listen, Jamie has been a close friend and one of the best mentors and leaders I've seen. And I think whenever you see things, you want to tell your organization to look closer, make sure you're very disciplined, be a good fiduciary, be a good risk manager, and we all will have our moments. Everybody that has spoken at this conference will have their moments, and you just have to make sure that you're doing it better than the others, and trying to show the dispersion that will come out when you do have those cycles.
I guess what I'm trying to understand is if there is a disruption, where it comes from. Is it from government then, because they're over-levered?
Well, I think that for what we do, I think obviously private credit there has grown significantly. So we've grown from like 300 billion back when I first started, maybe in the 90s, to now what, 2 trillion, and I know Mark Rowan was quoting more like 40 trillion if you include all the private high grade. Anytime you have an industry that grows like that, there will be pockets where things are more difficult. I think that the areas that we're watching are smaller companies in the U.S. in particular. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that creditors or lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software, really in the 21-22 vintage that was pretty highly priced, and that as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
There have been some, and Bruce Richards among them from Marathon, now part of CVC, who will be speaking at this conference, saying that the issues with software harkens back to 2016, what happened in energy markets, that oil prices go negative, energy credit is an issue, and it has a wider spillover effect. If there is an issue with software and you start to see defaults pick up, are you concerned that it might have wider ripple effects, or do you see it as very confined to the sector?
Well, I think the comparison to energy is a little different, right? You had a commodity risk that is very hard to hedge. So we don't do a lot of commodity lending.
Sure.
And that's a different business really and a different risk profile. I think on the software side, you will see, again, same themes, smaller companies, models that are easier for AI to disintermediate will struggle. Obviously, every owner of a software company will try to morph that. So I think it'll be more dispersed amongst managers. Some will have done more. And again, it may be as private credit was growing during that 21-22 period. There was a lot of activity. People were trying to grow their businesses, and there now may have some of those loans that they have to make sure are going to become due. And if they struggle, then those firms are going to struggle.
So if the pockets of weakness are smaller, mid-cap companies and software, does that have any other economic ramifications? I think especially of small companies in America being the biggest hirers among the population. If those are the ones that are in trouble, is that a problem for wider American markets and economies?
I think the pace of technological improvement and the productivity improvements feel like the U.S. economy is going to grow its way through this. And obviously, you may have pockets of labor dislocation that will be hard politically, and we all have to work to make sure. In my career, again, over 40 years, I've seen as we get more technology, we need more engineers, we need more people to do more things, and I still am cautiously optimistic that we're going to work our way in that direction. But it's certainly a big technological change, bigger than anything I think we've experienced.
So if it's a moment of disruption, the pace of change is accelerating, be it technology or Western capital markets. When there's dislocation, there's opportunity. Where are you finding that opportunity right now?
Well, I think the interesting thing, and with some of this change, there has been some volatility. You've seen it in the equity market pockets and in the credit markets, where maybe because of some of the concern, the opportunity set is getting better. We've spent really the better part of 17 years being pretty conservative, tried to stay low leveraged, and so in a moment where maybe there is some dispersion, that's going to create opportunity. I think we see opportunity for the bigger players. So part of BlackRock now, being a scaled player, we're running a business now about $400 billion of capital across a variety of different lending activities or financial activities. And in that, we're seeing both borrowers and LPs want to work with partners that can be reliable, where you can be fast with capital, you can commit to them, you can deal with complexity. And then on the LP side, they want to see, we're fortunate to have a variety of different places where we can show them, this is your risk return, this is what we have in high yield, this is what we have in private credit, this is what we have in solutions, and you can bundle that in a portfolio that makes sense. And I think those trends are accelerating.
What then happens to middle market players who not only can't participate in that, but have lent to the smaller companies that, as you say, might have issues?
I think there will, as there always are, there will be middle market players who do very well. And then broadly, if your business, again, in credit, what we've always wanted to have a very wide funnel. So half of our business is non-sponsor, half is sponsor. Most of the middle market players and a lot of the players focus only on sponsor lending. So that limits them to sort of, and when they're just doing what they see, that creates a little bit of a problem. If I'm just doing middle market and then middle market goes bad, that's likely to not go well for the portfolio. If I'm just doing software lending and that goes bad. So I think you really want, and people like Mike Milken and others have talked extensively about portfolio construction, conservative building of the portfolios, that's what's going to carry the day.
So you mentioned the integration now into BlackRock, getting that scale, announced late 2024, finished July 2025. How has that gone? What has integration been like?
Well, where we left the other day, I think Mike Patterson and Scott French and I were saying we've worked as hard as we're ever working. So, you know, coming into a big organization is very exciting. I think, as I said at the beginning, BlackRock's footprint, and one of the things we wanted to get out of it was really the origination opportunity with everyone. And I had this a little bit at Goldman and JP, where we now, when any borrower in the world should want to talk to us about what can we do. That's working. That's taken a lot to, you know, really get going. And I think we're just in the early innings of that driving. I do think, and I think somebody might have said this on stage yesterday, the shortage is origination in these businesses, finding good assets and then being able to structure them and deliver them into managed accounts for LPs in a way that they have low single name risk. So that part's been good. And then what we've done with creating a $400 billion boutique within BlackRock, if you will, I actually think we've streamlined it. Like sometimes in business, you take big things and put them together and simplify it. And I think we've really simplified it for both borrowers and our LPs in a way that, but it's been work, and it's going to continue to be, you know, a fair amount of work, but very excited about it.
How do you see the existing BlackRock credit business? Because it does feel very different than yours. More middle market, mid cap companies versus, as you say, the split you have tends to be more kind of large cap.
Right.
How do you make sure that you can meld the two? How are you thinking about that?
There's been very little, overlap. I think in the middle market business in the U.S., I think there's been a little bit of overlap, and again, that's been a business with the companies growing less quick that you have to really be very disciplined right now. So we've been doing that, and I feel good about the team. Mike Patterson, Vikas Kaswani have done a great job, you know, trying to streamline and integrate that. In Europe, they had a middle market business that was pretty standalone and was very, very successful. I think that is also then people are able to say, hey, if I've got a bigger deal, you know, I'm mining for my middle market. If I get a bigger deal, I get to do that. That gets to be positive, and you get those positive benefits of having many different pieces of business together. So
I do just have to ask, because there was one of the BlackRock funds, one of the BDCs that was marked down 19% to NAV. Right. Again, a legacy fund, not one that you brought in. How are you managing that right now?
I think that there are pockets where you have to take a look at what the portfolios are and really take a look at, you know, how to continue to evolve there. That's a traded BDC. Right. So a lot of people don't know the difference. Some are traded public but non-traded, and then that's a traded BDC. So what you're talking about there is the portfolio took a mark, and then the shares are traded in the open market. And you know, you just have to be a good fiduciary and a good risk manager. And in that one, we're trying to help continue to drive what's right for both the borrowers and for the investors.
By the way, I did do my homework. H-Lend, which is a non-traded BDC, you had your marks at the end of this year.
Yes.
And staying very steady there, marked of only 5 cents, very, very negligible. There have been other BDCs, though, that have reported that have seen some discounts to NAV. Is what we're seeing now, and you're talking about the risk management, is it signs of stress, or is it just a return to historical norm after a period of low rates and maybe easier returns?
Yeah, I think you're hitting on something that is hard for the press and hard for media to really understand. When you see defaults, you see things happen. We were in a period of very low defaults during when interest rates were very low during COVID. Coming out of that, you are returning to normal and getting to more of a 3.5–4% default rate. Again, what matters in credit is not defaults, it's losses. We've had a very good history and track record of doing that, of building big portfolios with very low losses, and we're super proud of the business we built. And again, I think as we see more dispersion, we're going to show how that performance and how that fiduciary focus, risk focus, low leverage will hopefully shine.
Sometimes, though, returning to the mean can feel painful for people who got used to lower rates, especially as the industry starts to push into retail. Do those two projects come into conflict with each other, of trying to bring more outside capital in at a time that, yes, it's just a return to the norm, but you start to see defaults pick up?
Right. Well, you mentioned Jamie. I mean, Jamie did say, anybody can make a loan. Not everybody that makes loans will go well. That's true. We also have a group that focuses on, and if loans do go bad, we need to be able to go in and take over the company, be able to manage that to optimize the return. Not every firm has that. Not every firm has the scale to afford that or the talent to do that. And I think that's something that will differentiate people. If you're just saying, okay, I'm out, then you're going to have much larger losses, and that's not going to be good.
It feels like just even more consolidation, Scott. If you have companies, if we remember the mid-cap players, you said, yes, some of them will do well, but maybe they don't have the teams to take back the keys. They're already dealing with companies that are under stress. The consolidation that's underway, just how dramatic are we going to see this evolve over the next 5 years, let's say?
Well, it'll depend on performance, right?
True.
I think that back to what you were saying too, there were periods where I mentioned 21 and 22 where software was very hot, firms were growing their business and wanting to lean in, and there is a little bit of okay, we wanted to grow. I think most of the big managers are very good at managing risk, and the scaled players are going to continue to benefit from this period. I think when you have less scale and you're doing more niche-y, what do I see? I'm only seeing a limited thing. That's a tougher spot to be, and I think those players will struggle. But again, they can have a business that's small. It's not going to be what I was talking about in change, the restructuring of the capital markets and big pools of capital. That's a different game that they're playing.
Scott, I'm afraid we are going to have to end it there. Thank you so much for joining. This was a beyond fascinating conversation. Everyone, please join me in thanking Scott Kapnick.
Thanks very much.
Please welcome to the stage Hsin Hung, President and CEO at State Street Investment Management, and John Zito, Co-President at Apollo Asset Management, for a conversation with Bloomberg's Lisa Abramowitz.
I'd like to begin by thanking both Hsin as well as John for being here today for a conversation that will focus on one aspect of the private credit ecosystem that has come under increasing scrutiny, which is retail investors. And I want to start because you two are both combining your efforts to create retail-focused funds, ETFs, that are backed by the credit markets and private credit in particular. Could you just start by saying how complicated this moment has made that effort, based on the fact that that seems to be sort of, boogeyman number one?
Well, we got started working together, 3 years ago, before we launched our very first ETF, about a year ago, actually. And because we're such a large ETF issuer, we care so much about liquidity, transparency, efficiency. I mean, that is what the vehicle is all about. And so a lot of that work has been working with Apollo in terms of not only sourcing the investment-grade private credit, but also the intraday liquidity. And one of the most fascinating things is in the course of this year, as we've provided transparency to the underlying, we're finding other parties interested in making a market. And so it's very early days, but I think private credit is not just one big asset class, and we focus really on the investment grade side where it makes sense that that liquidity would start to show up.
It's great because it gives us a moment really to differentiate between sub-investment grade credit, which is the tiny slice of the $40 trillion market but gets 95% of the press, and the investment grade side of the...
Feel targeted.
Yeah, exactly. To 95% of the business, which is, providing very large investment grade deals for, you name it. We've done 50 transactions in the last 24 months. Intel, BP, Air France, RWE, EDF, multi-billion-dollar transactions that are on, in some cases, 100, 200, 500 billion dollar market cap companies, and it's just a totally different risk profile. And just because it's privately originated or privately structured, it gets put into the same bucket as, you know, sub-investment grade mezzanine lending in some cases.
I guess that right now there's a fear of what isn't known, and there's a question about why something would get financed in the private markets, which traditionally was a more leveraged finance asset class. Why would it be financed in the private markets when they could have gone to the public markets, right? So what is the value proposition offered to retail investors by going and getting access to private markets?
Yeah, I mean, we're in this unique time where we need multiple trillions of dollars in the US, multiple $1 trillion in Europe, Asia as well. All the AI stuff, spend from power, infrastructure, chips, everything requires a very bespoke, long duration that's not traditional to the CUSIP market. And so if you want to work with somebody and actually commit 10, 15, $20 billion over the next 10, 15 years, you really need insurance and retirement type long duration capital to match with that. And historically, the capital markets was just equity and debt. And the scale and size of the need is so large that you have to access different markets. So it doesn't mean we're only going to do private markets. It means, hey, you may have, you know, AT&T did a pref with us, $2 billion. You have $140 billion of debt. Because they did $2 billion of private debt to diversify, to have a different ecosystem to have access to have a different funding source in times of dislocation, does that mean that that $2 billion of over $100 billion of outstanding debt is risky? Yeah, exactly. So it's like, it is, I joke internally, unless, you know, Claude and AI figured out a way to make private credit riskier in some way, in like some way that I missed or something, or that it made credit junior to equity. I haven't figured that out yet, but if it figured it out, I guess that's a different type of risk, but I don't think that's happening anytime soon.
Well, Hsin, from the perspective of the retail investor, what then is the value proposition if it's the same debt, just in a different name, right? I mean, is it traditionally it offered more yield? Does it still have to?
I think it still does. And if you look at, we've now, are in the process, we've launched 2, we have another one that's coming. And it's a combination of public and private debt, so it's not 100% private credit. And in many respects, the use cases are actually quite a number for both institutional investors as well as retail investors. And in fact, our very first ETF, it really competes in sort of the investment grade core plus category. And if you think about plus, most investors or most managers have delivered either high yield or emerging markets debt as that plus piece. Whereas in this case, we're really talking about that yield premium you get in the private markets. And so you've seen it over the course of the year in terms of the relative performance of this vehicle. And so it does give investors, retail investors, some exposure to an asset class they might not otherwise get, but it also makes sense for institutions. You know, that it is an alternative way of delivering that sort of exposure. And if they're sitting on cash ready, waiting to put that to work, this is a good place to be housing those assets.
So if I were listening to what you guys were saying, I'm like, what is this about cockroaches and people doing dumb stuff? You could go up here, well, it's a typical instrument tied to AT&T. I mean, what do you make of the discussion around what we're seeing in non-investment grade debt, potentially debt tied to software, potentially debt that was underwriting with less stringent standards than you may like to see? I mean, what do you see unfolding right now in private markets? How would you characterize it?
Yeah, I mean, in our product, we do zero. It's 100% investment grade. So the reason we're focused on the investment grade side is really what we've partnered on has been none of what's been in the press, but still gets put into the private credit bucket. We've been, you know, I got into credit to actually be out of the press and actually be a pretty boring business, and apparently it is the most exciting business on the planet.
I'm sorry.
Doing senior lending against large companies is apparently extremely exciting. So we have to talk about it a bit more than I expected. Clearly, we're going through a technology cycle and a platform shift in the world that and people typically don't like change. And so when you go through a platform shift in the way that most businesses are going to operate and most things, there's going to be some level of disruption. And in this case, clearly the eye of the storm is software. And just like in almost every other cycle, I'd like to say that what I'm saying is new. It's not that new. MLPs had a really hard time in energy crisis. Any sector that goes through a platform shift, if you're overexposed, asset managers in that feel tremendous amounts of pain, and you get exposed on the risk management side. And that's kind of what's happening, I think. It's early days. I don't, if the software, if the technology keeps getting better, I suspect it will not just be software, it will be services and other sectors that will get exposed. And one thing that's being missed by the private markets is we're doing stuff and funding the next 10, 15, 20 best companies in the world. Like it's not just all bad. We're funding 10 billion for SpaceX in terms of GPUs. We're funding Intel's fab. We're funding Databricks. Like you talk about the single best companies that are being formed, and there'll be 10, 15 new trillion-dollar companies. Credit is the centerpiece of that. And growth investing is going balance sheet heavy because you need all this infrastructure, manufacturing, robotics. You're going to need so much credit, and all of these growth businesses finance themselves with pure equity their whole life. And so I think the exciting part about it, I mean, again, the negative is obviously what it disrupts, but the exciting thing is that growth investing is going to be a balance sheet heavy business, and credit and private markets is going to be the financier for all these great companies.
I love it. When I talk to equity guys, they're like, oh, the problem is it's becoming asset heavy. And you talk to the credit guys, they're saying the nice thing is they're becoming credit heavy. Hsin, from your perspective, I mean, do you see this as being an isolated kind of MLP-like disruption, the idea that you could see one asset class, one industry affected? Or do you think that this could potentially have the nodes of something a bit more systemic?
You know, I think you have to step back from just private credit, right? I mean, AI is such a transformative technology, and we're seeing it in terms of, you know, impacting different sectors. There's going to be winners and losers, which companies adopt it in a very meaningful way to establish competitive advantage, and which are going to be slow to doing that. And so it's a tougher environment, I think, to be investing. Like John, I think private credit's going to be here for a long time because the needs for debt financing are not going to go away, and it's not clear the banks are going to be in a position to provide that type of lending. But it's a time where diversification really matters a lot, thinking about what are the implications as we move forward. And so, you know, having a broad-based exposure, whether it's in private credit or in equities or whatever sector, is really important.
I've been surprised by the isolation of just private credit. I think there's still a complete misunderstanding of what that represents in the economy, meaning 8,000 private companies, broadly diversified. Obviously, some asset managers more than others, but if the private credit market goes through, as UBS said, a 15% default rate, the idea that the public high yield market, the public equity market, all these public markets would be completely fine while the entire private debt market melts, the likelihood of that is extremely, extremely low. And it's been interesting to see how the public markets will say that this will have a very big problem, but everything else will be fine.
Do you reject that type of assessment by Matt Mish over at UBS?
Listen, I think if you read the piece, it was a little bit taken out of context. I think it was kind of his severe bear case, and there's some probability that that can happen. And again, anybody can go out and say that the tail looks like this, and it could. But to say that it will only happen there and that we shouldn't be worried about all these other markets, when in fact we're senior debt on all these other markets, that, again, not really logic behind that, but for whatever reason, it's definitely the story of the day.
Well, there are two ways to look at this. The first way to look at this is that people are overly penalizing private debt and saying that there is an overemphasis on underwriting standards that are weak, et cetera, and that there'll be just a right sizing, and you'll see some of those marks come back if the marks ever were there. On the flip side, you could take a look at this and say, actually, people aren't recognizing that there is deep pain to be had, that this washout is going to be much deeper, and it is going to be representative of a larger credit cycle throughout all asset classes. Where do you sit on that?
Again, I am more in the camp that the next 12 to 18 months are going to probably be more difficult. There'll be more dispersion. And again, when we're going through a platform shift at the core foundation of how things operate, that's a really difficult time typically for many companies. Not all companies, but many companies. And so the way to protect from that is be diversified, be senior, be income oriented. So I think a lot of the things that represent why people get into private credit, which is to de-risk, be safer, go senior, it's kind of getting lost with the fact that obviously 30% of that market was software oriented and is really center of the storm. So I'm probably more of the camp that we have a tough 12, 18 months ahead of us. But there'll be clear dispersion coming, and so it'll be interesting to see.
I think we're going to see a lot of signals from the public markets, frankly, because these same issues, whether AI is going to, really impact the software business, any other sector, I mean, that's going to be coming through as investors are worried about the impact on different companies. So I'm sort of with John. I mean, I don't think of private credit as being like by itself. It's part of a broader ecosystem. And I still think we're early days. I mean, there's different theses around, okay, what's the impact? I mean, some software companies may argue that they've got really enterprise integrated models that are incredibly important. The data is valuable. And so where this ultimately settles out, I think time will tell. As we think about different sectors that look like in 2026, we're going to see an ROI from AI is probably healthcare technology or manufacturing, energy discovery, but it's not broad brushed. I think there's a lot of companies obviously embracing it, but then figuring out where does that really move the lever in terms of returns or risks, I think are still to be played out.
This morning on Bloomberg Surveillance, we were talking about how there are these three major risks right now that seem to be buffeting markets. On one hand, you have the question of AI transformation. On the other hand, you've got questions of these pockets of risks that are emerging in private credit. Yes, private credit, but also particularly tied to software and particularly tied to a couple of specific funds. And then you have this third thing thrown in the mix over the past 5 days, which is an oil price shock, which could potentially increase inflation risks, reduce the chance of the Fed cutting rates. At what point does a tightening in financial conditions tied to that type of exogenous shock sort of preempt, escalate, accelerate any kind of credit cycle that you see coming through the pike as a result of the fact, A, we haven't had one in a long time, and B, the fact that there is going to be a lot of change and people don't like change?
Yeah, I think the question is going to be sustainability of what's going on in the last 5 days. The longer it goes, the more it will be priced into markets, but for now it's been somewhat mute in terms of long end. In AI transformation, I think the big question is not whether or not it will make people more efficient. It will be how efficient does it make people, how efficient does it really make people, and what will happen to the labor market in that, and what really happens to the consumer on the back of that, because that has been the big pivot. You've seen some pretty severe headlines from a change in the forward labor market. That I think that's really the big question for markets and how strong the consumer holds up. We're coming into this with $30 trillion of home equity, so it's a very different backdrop than 2008. So pretty strong in terms of overall balance sheet, but clearly, I think consumer confidence is in the early to mid innings of actually slowing, and I think that will probably start to show up in the numbers on a go-forward basis.
Yeah. I mean, time will tell, right? I think the market's reacting to every headline as it comes across, trying to read how long is this conflict going to last? And the longer it does last, the impact to oil production and energy transport could translate in terms of higher inflation or longer period of time. But our view still remains that it's a K-shaped economy here in the U.S. and that the lower income populations is where you're seeing lower wage growth, increased delinquencies, unaffordability. And so we still believe that, the Fed should be in a position to be cutting rates rather than hiking rates. But it may take longer for that cycle to begin as we see what plays out.
Given all of the potential shocks, we were just speaking with Dilhan Pillay of Temasek, and he was saying, for about a decade, they had an illiquidity premium. They wanted to be involved in private markets. And recently, because of all of the shifts, they've said that there's a liquidity premium. I'd be curious what you think about that, given the fact that retail investors tend to look for that liquidity premium, right? I mean, that's the reason why they're going into private markets through an ETF. I mean, do you see there as being a dissonance right now between retail investors' appetites and the reality of a pretty complicated world?
Well, I think the environment we've been in has shifted quite a bit, right? That's an understatement. I mean, fundamentally, you have so much value creation happening in the private markets. If you think about companies with 100 million more of revenue, 85% of them are private. And so you look at overall individual portfolios and allocations to alternatives, whether it's private credit, private equity, real estate, is very low single digits. On the other hand, institutional investors have had very large allocations. And depending on your horizon, right, there's logic for these assets to be within individual portfolios. Now, I think this is where asset allocation comes into play, right? And we think it's a good thing that model portfolios have been growing, thinking about where does private markets belong within a portfolio. It should not be in that sleeve, which is your liquidity need. It should be fulfilled by other parts of that portfolio. So it's an evolution, I think. Longer term, still bullish on the asset class. But at the same time, I think it's really important that individuals, especially those that are thinking about these asset classes, are thinking about where's the right context for them.
I mean, we've set up our business because we invest half our balance sheet with our own balance sheet, and we don't say put $1 in private and put $1 in public. We just say put $2 in credit. And the markets between private and public are moving so quickly. The ability to actually asset allocate from the outside without being able to assess, okay, are the private markets better today versus the public markets, or where should this private asset price based on this public markets? The whole industry has been built siloed. And we're trying to bring that back together where it's just, okay, invest in the best credit assets that generate the best income orientation and the best risk reward, and not make it about private or public. And that, I think we're still in the early innings of that, but the market structure, the asset management structure, the product design, the delivery mechanisms, all of those things are going down a path of much more asset class focused and private public agnostic. And again, that's a big change, but I feel like this is forcing it. It's forcing all of this to become one.
Do you think that the Blue Owl issues and of late the Blackstone issues are creating a challenge for creating those dual ecosystems of liquidity, given the fact that I believe 25 Blackstone partners contributed $150 million to help with the redemptions of 7.5% of a particular fund?
Yeah, again, you describe them as issues. I don't think they're having issues. I think they're making decisions on how to meet their client needs, and everybody has a different client set and a different view of exactly how they want to approach that, and they did what was in their view the best interest for the client. These products in private markets have historically been built in closed-end and drawdown funds, and now they're in quarterly liquid funds, and you have to have first principles about how you want to treat each client. And so I'm hopeful that this is an experience for all of us to make sure we treat our existing clients as fairly as possible in the moment, but also acknowledging that we don't know what next quarter or the following quarter is going to look like. And so we have to make sure that we treat everybody fairly. But I think going through this, and it happened in the real estate business for a while, going through this I actually think is going to be great for the industry.
Well, hold on a second. And you can answer in 1 second, but I want to press you on something. I know you're like, please don't.
She waited till 2.5 minutes to ask me this question. she waited till the end.
What do you mean by treat fairly?
No, listen, when money's coming in and out, there is always the question of, okay, what's it going to look like next quarter and what's going to happen in the world, and there's lots of variables. For anyone to say they know exactly what the world's going to look like in 3 or 6 months, you have to look forward and say, okay, are we doing what's in the best interest of our clients and the long-term experience of the clients over time, and is it consistent with exactly what we said we would do at the beginning? And all of those, it's just critical that the industry does that. And listen, the people who are really big in this industry have been doing this a really long time, and they're really big for a reason. And so I'm hopeful that this experience, no matter how long it lasts, actually brings more confidence to the industry, at least to the people who behave appropriately.
And I think we already were seeing with these interval funds, BDCs, an increasing move to daily marks, much more transparency. I mean, in many respects, that's what was front of mind for us when we built our products together, was to make sure that that visibility was there for investors. And I think that, you know, some of those aspects that you get in the public markets probably do find their way into some of these vehicles. And perhaps that is, you know, one takeaway from this experience.
My final question is, coming into the year, there was a lot of discussion about how retail appetite for private credit was significant and growing because of certain regulatory backdrops. Has this episode changed that at all?
I mean, I think, look, long term, where retirees are growing at a very fast pace. It's not going to peak. Retirees in the U.S. are not going to peak until, I don't know, depending on your numbers, 2055. So you're going to have more retirees, and the baseline is that retirees are going to want to de-risk, which is historically to go into more income and more credit. And at the same time, you have an AI boom going on where you need $4 trillion of new money that's super long duration that matches exactly with the retirees' expectations and return stream. So the broad high level is highly likely that credit allocations go up. The question is, what's the delivery mechanism? What do people want? Do they want private IG? Do they just want credit? I think that's still getting figured out, but you're going to have to be you're going to have high amounts of adaptability to actually win. But I think credit allocations over time are going to go up just by the math.
I think that's right. Demographics would suggest that that is the case.
We're out of time. I have a lot more questions, but thank you so much, Hsin, as well as John Zito. Thank you so much.
Please welcome to the stage José Feliciano, co-founder and managing partner at Clearlake Capital Group, and Mahesh Sareddy, global co-head of the Capital Solutions Group, Global Banking and Markets at Goldman Sachs, for a conversation with Bloomberg's Davide Scigliuzzo.
This one. Good morning, everyone.
Good morning.
Morning. Jose, thank you
Afternoon
for being
almost,
here.
Yeah.
As I was preparing for this, Jose, I want to start with you. I noticed that Clearlake is turning 20 this year. For the vast majority of that time, you've been mostly a private equity firm. Then last year, you made 2 acquisitions to kind of increase your presence in credit. How is that integration going? How are you thinking about sort of that side of the business, given all the kind of concerns around credit and private credit in particular right now?
Yeah, of course. Again, good morning. I'm very happy to be here. Thank you, Bloomberg. So yeah, we're almost no longer teenagers. We're going to get to that 20-year mark. What's interesting about Clearlake is from the very beginning, the premise of Clearlake was built upon this idea that kind of the capital markets are more of a spectrum, a continuum, right? Rather than this strong delineation between equity and credit. So we always, even though we have private equity funds, and that has been our core product over the past almost 20 years, we have always had a credit component. But certainly in the past few years, the world has changed, right? The world of alternatives has changed quite a bit. And with essentially the growth of not only credit, but private credit and hybrids along the way, we think the world looks a little bit different. So short version is that we think that the winners of tomorrow need to have broader conversations, deeper conversations with their clients. And those conversations need to encompass different solutions, bespoke solutions, credit, private equity, and everything in between. And the acquisitions of Pathway and MB Credit clearly position us to kind of be a more global firm, but also more interestingly a firm that can have those conversations across multiple products, multiple segments, secondaries, infrastructure, credit, private equity, et cetera, et cetera. So we think we're well positioned. But again, this is just the second decade, so looking forward to what's to come.
And to many more, obviously, but are there other areas that you would be interested in expanding into that maybe right now you don't have a strong?
Yeah, it's interesting.
You look out a few years.
With this, I think we have a toehold in pretty much all the significant parts of the market that we are interested in. But clearly, there's a lot more to do. When you look at the market, we'll talk about it probably today, but you look at private equity and the way it has evolved, and then you think about the secondaries market, a very small part of the private equity commitments really trade in that secondary market, right? And that's changing dramatically, and you can see that, kind of exploding in a positive way, meaning, massive growth for that secondaries volume.
Yeah. Mahesh, I want to bring you in with this because it's been, obviously there's been a ton of consolidation in the asset management industry. We've seen a lot of firms that expanded from the roots into equity into other markets, and liquid fixed income managers getting into private markets.
Yeah.
How far along are we in sort of that process, and how much more consolidation would you expect to see sort of across that space?
Yeah, again, to the point that Jose made, right, I think one of the things that we continue to notice is the differentiation between public and private markets continues to compress, right? So it's happening from both sides. When we think of issuers, when you think of our clients who are looking to raise capital, they are more comfortable now than, say, 10, 20 years ago around a desire to look at both the markets, both solutions when it comes to kind of, how are they going to raise capital. And the same thing we are seeing on the investing side. On the investing side, we are seeing kind of sponsors expanding from monoline PE shops to like a much more diversified alts shops. Money managers like BlackRock, PIMCO, who are kind of more in the liquid public security management business, kind of getting more into, with the acquisitions that they've made, getting more into the private market. So I think we are still in the early stages of some of this consolidation that's happening. So I think our expectation is the industry will continue to evolve. I think we've seen some, but I think there is a lot more that has to happen, because longer term, the winners will really be the ones who have a very diversified platform that can serve the entirety of the capital structure. So we think that's the direction of travel, and we'll continue to see more of that.
Yeah. And I want to get to that point about secondaries, but first to stay on sort of the traditional private equity for a minute.
Yeah.
It's been a tough environment for a while in terms of fundraising. Do you think there is a sort of resetting of expectations for that industry, and what returns look like, what fund sizes look like, what deal sizes look like?
The answer is maybe, a strong maybe. We have seen this before, right? Private equity has gone through different periods where, compared to specifically the public market benchmarks, private equity returns have potentially lagged, right? And oftentimes, by the way, those are the best times, the best vintages to actually invest and deploy capital. Mm-hmm. Most investors, it's a strong temptation. We look in the rear view mirror, and then we extrapolate. Oftentimes the world is different, right? And instead of moving in a nice smooth curve or line, you have step functions and sometimes jagged edges, kind of to return. So I think, as always, though, private equity, what we have done well in the industry, if you look back at the past 20 plus years, is reinvent the industry every decade or so, right? Kind of what started out as really levered buyouts with a very heavy financial engineering component has transformed over the past 2-3 decades into being real stewards of companies, kind of implementing real governance, implementing real operational improvements. And the laws of gravity haven't changed, right? Kind of, are interest rates higher than they were, 5 years ago? Of course they are. Is the economy perhaps going to be a little slower, maybe driven by significant disruption coming from sectors like technology, energy, AI, of course, being kind of a big overriding factor right now that we're talking about, of course. But at the end of the day, our job remains the same. We buy companies, we try to make them better, hopefully bigger, hopefully accelerate that growth, hopefully in the process making them more strategic, more essential parts of that ecosystem. And if we do that, maybe not tomorrow, maybe not in 6 months, but I'm pretty sure that over a 5 to 10 year period, there will be strategic buyers, there will be other financial buyers, there will be continuation fund vehicle opportunities, all kinds of ways of exiting that are and we're going to be able to make money. can I say, hey, we're going to make 5 times our money in every deal? Of course not, right? In a higher interest rate environment, do you think that on average, returns in private equity will be somewhat lower? Of course they will. But I think the opportunity in private equity remains the same. There's always an opportunity for good owners, particularly those that can add operational expertise to make companies bigger and better. And if you can do that, you will be able to be profitable and make great returns in private equity.
What's your take? Is there a question of having a bit of patience? And
I think the only point I would add there is obviously it's a point in time question, right? Like if you look at what's happening right now, there's 3.8 trillion to 4 trillion of like assets that have been sitting in PE, PE funds for call it like 6 to 7 years, right? It's 30,000 plus companies. So there's always a tendency for markets to overreact to both sides, when things happen, right? When PE returns were really good, everyone was like, PE is the best thing in the world. We're going to invest heavily in it. Now, over the last couple of years, obviously, when DPI has been lower, when some of the exits, again, a lot of this is vintages, kind of 5 to 6 year ago vintages, exits have been a little bit slower. I think the market will probably tend to overreact a little bit to the other side. Is this kind of the the phase where PE the PE shops will have a tougher time? I don't think so. I'm with José on this in terms of like longer term. I think there is a need for that type of capital in the market. I think people will change the way they underwrite, right? Because if you look at the exits through public markets have gone down dramatically, right? The IPO market, again, obviously we're nowhere near what we saw in 2021 in terms of 400 plus billion that was raised in through the IPO market. This year maybe we'll touch 200. So as the IPO market is demanding a different type of companies to kind of be in the public domain. So I think as investors underwrite and the assumptions they make around exits, the assumptions they make around like, the returns that they want, they might change a little bit as we kind of go through this transition.
Is that just on valuation or debt levels or,
I actually think on debt levels, it's not a problem. If anything, again, I'm sure we'll go into the private credit space at that point, but the availability of debt is as good as it's been. We can, of course, the last 1 to 3 weeks felt a little bit different, but if we take a longer horizon, I think getting debt actually continues to be fairly available. Yeah, it's the easy part, right? It's really the exits. It's really the volatility around the exits, right? Like you underwrite to a base model, but if that doesn't happen, then how much cushion do you want to leave and what are the returns you want to make? So those assumptions will get tweaked and the return expectations might be higher. But point in time actually is a great, if you have a secondaries fund, it is a very interesting and exciting investment opportunity.
Yeah.
Right? So I think, so I do think, again, some assumptions might change, but on a longer horizon, this industry will continue to kind of tweak assumptions, but still be a very, very profitable business.
Yeah. And José, how are you thinking about exits in this environment? You mentioned continuation funds that have become incredibly popular. I think they've been gradually more accepted by LPs as well. There's different versions, multi-asset, single asset. How are you thinking about that space?
Yeah. Well, maybe as a continuation of what I mentioned before, our job is to buy these companies, make them bigger and better, and then exit the companies. And there are multiple ways of doing that. People oftentimes say, well, the preferred way of exiting is XYZ. Well, the preferred way of exiting for us is whoever pays the highest multiple, whoever pays the highest price, whatever generates the highest return to our investors. At different times of the cycle, that may be different. And there are times in the cycle, particularly with some companies where strategics are more active. Oftentimes, financial players are more active. And sometimes the IPO market or equivalents, right? Kind of we saw SPACs, for example, for a while, had a little bit of a renaissance, and then they retreated a little bit. Continuation vehicles, to me, is just another private exit. Here, you're substituting maybe perhaps, instead of another sponsor, you're substituting perhaps a group of secondaries players, right, that are leading that transaction, and then with the help of maybe rollover capital or even, kind of existing funds. I think it is a legitimate way of exiting, particularly the way we did it. Our version, our flavor of continuation funds, or at least our aspiration was to do that with kind of the best of the best companies that we were confident that we wanted to own for an additional kind of phase of growth, where that continuation vehicle could be a catalyst for that growth, meaning that that additional capital could be used for acquisitions or whatever was pertinent for that company, and then obviously ultimately get to an exit. And we have done that, kind of partially, and in some cases, kind of totally. But I think you have to look at it on a deal-by-deal basis. It's no different than private equity. There'll be some continuation funds and some companies that are great candidates for continuation funds, and some that perhaps are not. And you have to look at it on a company-by-company basis.
Right. And we've seen a couple situations where maybe that hasn't worked out, but it doesn't kind of detract from the idea that
if you're taking risk, by definition, not 100% of everything's going to work out. At least I've been in this business for a long time, have now a little bit of gray hair, and that's my experience.
I have more than you, so you're still doing fine.
I don't have any hair, so I don't know if we should be.
I was just at a conference in Las Vegas, structured finance event. There was a lot of talk about sort of solving for some of these issues that maybe are temporary, whether it be fundraising or liquidity or even returns with structured products like CFOs, rated feeders, and all of that. Mahesh, I'm curious to getting your perspective on like what kind of conversations you're having with clients on that front, and what's that kind of like the new frontier of that of those type of products.
Yeah, definitely. So I would say, when we speak to clients, right, there is a continued evolution of the industry, right? It started with kind of you start doing NAV loans on your positions as a way to like do a DPI. Or by the way, NAV loans started when the leveraged finance market was shut down for a little while. So instead of taking a company by company, you started doing portfolio, you did NAV loans. That was kind of one way, one innovation that happened probably like 3 or 4 years ago. Rated feeders, CFOs, I think all of these, the way I think of it is a little bit more of different ways in which you can get capital into the private markets, right? So these are all, these are all kind of instruments, especially some of these are very well suited for insurance companies, right? Yeah. So as insurance becomes much bigger player in the alts portfolios, they are getting financially savvy in terms of the investments they want to make. So the result of that is the evolution of all these products, and we are seeing continued growth. If you look at kind of the total quantum across all of these types of capital raise that has happened across rated feeders and CFOs, I think that continues to grow. Our projections are that that will be another tool that will be available, especially as we said, the presence of insurance companies in alts portfolios grows. So we expect our clients, and we are seeing again as with anything, right? When something new happens, some clients are very hesitant to use, some clients are very open to use, but over a longer horizon, I think adaptation, if the product is successful, will be there. But right now we're in that phase of like education as opposed to like fully adapted when it comes to some of these products.
Right. Does it feel like it's a bit of a temporary solution to maybe plug a gap until an exit, or do you expect this to become something that's just embedded in how these markets work?
Again, obviously, I've been around these financing structurings for so long. You go back in time when people started doing capital call financing, right? People started doing just kind of like, borrowing against you.
So basic now.
Yeah. At that point, I remember a lot of debate around like, is this financial innovation or is this something that will be adapted by everyone? And today, that's a $1 trillion+ market, right? That's just like so my view is, some products will become like that. Some products will at some point kind of fade out. But I think more of these, I think in my mind, will probably some things that will exist for a longer time.
Yeah. We've had a lot of conversations at this event about sort of where the capital is going to come from. You mentioned insurance and that interest in private markets. Jose, I'm interested in getting your thoughts on the sort of retail side of the picture. There's a lot of discussion about giving retail investors, including all the way into 401ks, kind of access to private markets, whether it be private equity or private credit.
Yeah.
Is that a good idea? As someone who runs a private equity and credit firm now, how do you think about that?
Sure. Perhaps the natural instinct for people on my side of the table is to say, yes, of course, any new source of capital is good. I think we have to be very careful when we talk about this, because first of all, to me, it all starts with we have to be client-driven, right? Kind of what are clients looking for? What is it that they want? What is it that they need and want, right? This is not like medicine that we're giving it to them because it's good for them, but they don't really want it. I think, so we have seen a massive evolution in the retail markets, and those have evolved, right? Kind of traditionally private equity funds, for example, have been offered for a long time, in the large private wealth, kind of ultra high net worth networks. We're talking about a much broader democratization, right? I think my own view is that some of the products that are going to be most suitable for that retail market may not be pure play private equity products, at least not initially. There's also an educational component that comes with it. But I think there's some products that, of course, certain flavors of credit, very well suited for the retail market. Secondaries, again, flavors of the secondaries, it could be really well suited. Infrastructure, perhaps. Even private equity, maybe kind of in a different package, in a different flavor. I think we need to be very careful about how to communicate. Things like liquidity, duration, all those type of things need to be very clearly delineated for that retail investor. So I think it's great, kind of to be able to do that. I think alternative products do belong in a diversified portfolio, kind of in the context of that retail market, particularly as you get to kind of larger portfolios or higher net worth individuals. But we just have to be very careful how we do that. We have to be very careful that we meet that demand from that client, but also communicate very clearly, the risks and benefits of those products. But I think it's here to stay, and it's certainly a growing market and one that we're paying real attention. And in some ways, our acquisition of Pathway was a little bit thinking about that product, not today, but thinking about the demand for products in the next 5 to 10 years.
Down the line. Mahesh, we're seeing a lot of kind of discussion around private credit and that push into retail maybe as the precursor of a bigger push across private markets. What do you make of the situation we're in right now, and particularly with the structure of some of these funds? We heard yesterday a lot of commentary around this 5% cap on redemptions. That's a feature, not a bug. Yet a lot of funds are kind of allowing more than that to be redeemed. Is that kind of mixing the message in any way? What's your sense of what ultimately investors understand?
Yeah, I'd say, if you got to take a step back and look at the evolution of the private credit market, right? Like the private credit market really evolved post the global financial crisis, right? When banks wanted to do less and less of leveraged lending, that's kind of one of the first steps where a lot of these private credit players emerged. And what is the core thesis of doing a private credit loan? The core thesis really was you can go to the broadly syndicated market and you can get kind of a standardized documentation with like a spread, or you can do more bilateral in a smaller space, but where you are kind of doing a bilateral transaction with a smaller set of people and you're getting paid a risk premium, but in return for that risk premium, you are selling liquidity, right? So the core premise of the starting of what the private credit industry was, you can do something where you can get a premium around versus the public markets, right? Even today, if you do a private credit loan, you are getting a premium versus the public market. But in return, by definition, right, like nothing is free in the world. So in return, you are willing to sell the liquidity option because on a longer horizon, you're betting on the credit, not the short-term volatility of the spreads.
But I guess the question is then, is the push into retail then undermining that?
I think that goes to the point that Jose made, and I truly believe in, is it's all about education, right? I think again, I know one of my colleagues made this comment yesterday around, I truly think it's actually, if you want to protect the investors, the LPs who in this case happen to be retail, a fire sale of a private assets is not the way to do it, right? So this 5% cap, actually, what does it ensure? It ensures that there is an orderly liquidation that actually gets the risk premium that you paid for capture, right? So I think there is a little bit of a confusing messages sometimes around, at the extreme, if private credit is traded on a daily basis, then that's public credit, right? So we just need to kind of be a little bit clear on our messaging is, if we have more and more retail coming into all these private markets, I think the expectations have to continue to be set around the liquidity is what you're selling, but to get the higher risk premium.
Yeah.
And I think sometimes that gets lost when you kind of do these quarterly liquidities, and I think that's what's causing a little bit of, we saw this in the commercial real estate space about 2 years ago, right? Kind of a similar trend. So this is, I think that is exactly what's happening today. But I think, again, as I said, it's all about messaging to the audience.
I want to touch on sort of software and AI. We've seen a lot of concerns in that space and disruption. If you look at the public markets, I know Clearlake is a big investor in software as an industry. So I'm curious, Jose, what are you seeing from your seat?
Yeah. Well, of course, the past 45 days, the market has really come to this realization, kind of that, hey, software, the business of software, the model might change, right? And the markets reacted very negatively because it adds uncertainty in a part of of our economy, right? That historically, or for the past 15 plus years, has been seen as kind of the growth engine and a fairly clear, secular growth path. And now AI kind of brings that to a big question mark. Like we have been talking about, the markets overreact sometimes. I think the reality is that there will be some software businesses that are extremely vulnerable to AI threats, kind of both from a software development perspective, but kind of go-to-market perspective. If you are kind of a tool that sits, kind of on top of data provided by others, you're going to be very vulnerable. There's going to be some companies that are AI native, right? that are incorporating everything that we know about AI today, and kind of in the future, those companies are going to be very valuable, and there will be several probably trillion-dollar companies, right, that are created from that. There's a fat middle, as I call it, of companies, software businesses that are extremely good businesses. Their growth profile may change a little bit. The way they develop software may change a little bit. But the reality is that they are embedded in their ecosystem. They have the customer relationships. They perhaps have the nexus between suppliers or different parts of the ecosystem. And AI may become just a much more efficient way of developing that software, right? And it's interesting to note that in software, right, not always the best product wins, by the way. And AI today, at the very least, can accelerate that software development dramatically, right? You can go from a team that was like 20 people that would develop a product over 6 to 12 months. Now you can do that maybe with a team of 5 people over 2 weeks. That's dramatic. But at the end of the day, you need to have the customer relationships. You need to understand the business process around that. And the incumbents are going to have an inherent advantage. Whether or not you should pay 20, 25 times EBITDA, or 20 times revenue, or 10 times revenue, or 5 times revenue, that is a really interesting question. But the reality is that it's a target-rich environment today because there's a lot of that uncertainty, and people that understand software understand, this type of evolution, like us, where we have invested over 20 years in a broad range of companies, some that are growing very fast and some that are growing more slowly. There's going to be a lot of opportunities there.
Yeah. Mahesh, how easy it is to underwrite deals for software companies right now, and to kind of figure out in which bucket they fit? I'm going to blend in some of the questions we got from the audience here, but the pace of transformation is so rapid that how can you be sure which companies will be a good bet and which ones won't be?
Yeah, I'd say again, I think it's not, software is definitely the flavor of the last 3 weeks, right? But it's not just a software issue. Like from an underwriting perspective, right? What's happening with AI is a transformational thing that's happening that's going to impact many other industries, right? Today it's software, and there's a lot of discussion. Tomorrow it'll be in some consumer businesses where there's, commercial receivables. There's a lot of places where I feel the disruption of AI is going to happen. So it is very challenging to underwrite. And some cases actually will be where there'll be a massive beneficiary of the AI wave, especially data, right? As anywhere where you have access to data, anywhere you have proprietary data, that's the places where benefit from AI. And some places will have a massive tailwinds from AI. So from an underwriting perspective, I would say this is as complicated as it has been, because this big unknown of what you assume is kind of AI proof is rapidly transforming, could be an AI proof, or what you assume could benefit from AI might not. But having said all that, I think, again, not all software is the same. Exactly the point is, there is a lot of differentiation in terms of if you have a vertical software integrated company, that's much different. So we do have, a lot of clients that are asking a lot of questions around segments that they are very familiar with, segments that they think they'll benefit. But again, I want to keep going back to the point. It's not just software. It's other industries that are getting disrupted that will get a lot more attention. So underwriting overall is because we are into a world for the next 6, 12, 24 months, there's going to be a lot of unknowns. So it is going to be a challenging time to underwrite things.
You said it's as difficult as it gets, but to what extent is that sort of really preventing deals from happening? Like if you can't figure out the answer immediately, does that mean that deal? I think
the way it will manifest itself over time is in terms of risk premiums, right? Because our clients will then want anything. We are seeing that in real time where there is some delta around the outcomes, the risk premium that clients are asking are going to increase, right? For a long time, credit curves are pretty flat. Right, you didn't get rewarded too much for going out in credit or going out to equity, right? And that's kind of what we are seeing. If you look at, kind of again, single name stock vol is higher than what it used to be because the market is saying that underwriting single names is going to be more challenging than what it's been, and credit curves will continue to steepen out.
Yeah. By the way, quick comment. I think that's interesting to us because the dispersion of returns is going to be higher.
Yeah.
So better stock pickers, people that understand the industry and the company well, are going to do better. We think we're well positioned there. Number two, I see some comments from the audience about LLM's reasoning. They're not quite there yet. LLMs basically are based on data. So whoever controls the data has a better sense of capturing the rents derived from that data. And the LLMs right now are basically capturing really interesting correlations and relationships in that data that are not obvious to mere humans, but they're not quite reasoning just yet.
All right, we're out of time, but I can't show my face in Europe without asking Jose about Chelsea.
Wow, I thought I was going to do a panel about Chelsea.
Obviously, it's been a bit of a rough ride. The club reported a big loss, but sometimes you have to spend a lot of money to make a lot of money. I'm just curious, where are you sort of along that path, and how are you seeing that?
Well, we just won 2 trophies last year, so kind of it depends a rough patch for whom. Arsenal hasn't won in 20 years that I have checked. Or maybe they won something, but anyway, so we just won 2 trophies. We're in the fight for the Champions League this year. The reason that we have to end this panel is that there's a match in an hour or so.
Hard stuff.
I think very simple, right? First of all, if you own a sports team or a club, you have to understand that you're a steward of something much broader, and the impact in the community is much broader than just a business or just a sport. Second of all, kind of we take very seriously that kind of Chelsea has been a top 6 in the Premier League, and we intend to not only stay there, but we intend to compete for trophies every year. We intend to win the Premier League someday soon. And I think the reality is that I think we have put in place a much more sustainable system in terms of players, in terms of kind of development, that I think is yielding results right now. So we're excited about the season. It's a very tough league, the toughest league in the world. We're fighting to be that top 4 or 5 with kind of names like Liverpool, Villa, United, and I think we're going to do well. But it's a sport, so everybody has an opinion.
And you both have been a good sport. Thank you very much. Please join me in thanking Jose and Mahesh for their time.
Thank you, Jose. Thank you.
Please welcome to the stage Sean Edwards, Chief Technology Officer at Bloomberg.
It's kind of funny because my brother's a diehard Tottenham fan. I'm sure we can all agree that generative AI is having a profound impact on our industry, and it's a change that I've seen happen faster than anything I've seen in my career. And of course, this is all because of the models, the underlying generative AI. These models are fantastic.
right? These models have incredible properties. They understand a broad set of knowledge about the world. They have incredible language understanding. You can do translations and summarizations. But the thing I'm most excited about is that they can reason. For the first time, we have systems that we can give a goal to. It can create a plan, and if you give it the capability, it can carry out that plan autonomously. This changes everything. This reasoning capability is in what is powering new capabilities that we just couldn't build before. And we're seeing this in many, many different fields, including in finance. But for all of its strengths, it's actually hard to use generative AI to build trustworthy systems. And what I mean by that is to build a system that gives you consistently accurate answers over and over again. Systems that you could use to make mission-critical decisions in something like finance or medicine. And the problem lies in the fact that the models themselves don't have a ground truth. We have to give it the ground truth. Okay? And what is that ground truth? That is, for Bloomberg, it is our massive amounts of structured data that we have been collecting and cleaning and aligning or generating ourselves. It's the high-quality curated documents that we have been sourcing from high-value sources and creating metadata around it. It's the analytics that our customers have trusted for years. Things like evaluated bond pricing or a segment KPI prediction for a company based on observations alternative data like credit card spend or foot traffic and aligning it towards what the financial professionals are looking for. It's the portfolio risk models. It is the liquidity analysis that goes into it. So how do we make sure, the challenge actually is how do you use the reasoning power to make sure that these models don't use their world knowledge, but instead only uses the trusted sources of information. These models want to be very helpful. When it can't find an answer, it's more than willing to make things up. Okay? And so there's a lot of effort and a lot of research we have done to make sure that you're guiding it in the right way. And without getting too geeky and technical, it essentially comes down to, I'm simplifying it tremendously. My AI team would be upset with me, but essentially is you have to give it the ability to check its work at every single step, at every layer in the stack. What does this mean? This means that you have to build domain-specific checks. Often, these are our deterministic systems. Did you call that calculator with the right parameters in the right order? When you summarized a paragraph, did you faithfully ensure that all the information content came strictly from that paragraph and you didn't insert anything? These validators, these checks, are something that you just keep growing and building, and they are domain-specific, so you have to have the knowledge about what is right and what's not. So at Bloomberg, we build systems that are robust, comprehensive, and are accurate consistently. So for generative AI systems, that means we need to derive our answers from trusted sources. We have to check our work at every step, and we need to provide the transparency and the attribution to the users through it all. Okay? Now, we have taken these principles into account when we built AskB. AskB is a revolutionary rethinking of the Bloomberg terminal. It is a chat interface that allows a user to ask their high-level thematic question. The AI system goes and reaches into a whole network of distributed agents that operate on those trusted sources of information, and then it synthesizes an answer. This is a profoundly different way of building software for ourselves, no longer building screens and thousands of screens and having customers have to know the mnemonics, but it's also a profoundly effective way for customers to be able to derive insights that they would have missed or they wouldn't have seen. And as we go forward, we're adding more and more asset classes, more and more analytics, more and more capabilities so that the system becomes more powerful. But all along the way, it has to be built in a trustworthy fashion. So I highly encourage you to go look outside. There's a demo booth to look at AskB. And whenever you're looking at systems, do the evaluations. Spend the time to look at the quality. It's really easy to get excited about shiny demos. It's really hard to build trustworthy AI. Thank you.
Bankruptcies. There will always be bankruptcies. There are thousands of credits in the marketplace.
See one cockroach, there are probably more. And so everyone should be forewarned on this one.
Stage, Bruce Richards, founder, chairman, and CEO at Marathon Asset Management, for a conversation with Bloomberg's Matt Miller.
All right, thanks very much. I'm really pleased to be here with Bruce Richards from Marathon Asset Management. He doesn't really need an introduction, but I will say I've been interviewing Bruce for at least a decade now, and he is the first person that I heard make this call on software being essentially endangered by AI, and that private credit was overexposed to software. It was over a year ago. And so I'm glad to be able to talk to you, Bruce, about that now, because this morning you put out a LinkedIn post saying, maybe we can draw some parallels between what happened to energy in the mid-2010s and what's going to happen with software now. At that time, we had a 20% plus default rate for energy credits, and you think that we could go to 15% for highly leveraged software companies. Help us unpack that call.
So when you draw that parallel, I'll talk about the call in a second. When you draw that parallel, it's a difficult parallel to draw because oil and gas has nothing to do with software at a certain level. And any rating agency or industry practitioner would know that. In fact, the man in the street would know that. But here's where I see not the trees, but from up above, 1,000 feet down, looking beyond, the actual parallels that are strikingly similar that our viewing audience should understand. So number one, there's a major technological change that changed forever oil and gas. And it's called horizontal drilling or fracking, where you used to go down vertically, and now you can go down horizontally. And what it did is it completely changed the pricing structure for oil and gas. And with all the leveraged companies in the high yield market, in the broadly syndicated loan market that had that exposure, all of a sudden, when the pricing structure got crushed, all of a sudden, all the capital dried up. And you had, after that 2014 and 15, excess of drilling and all the financing required to support all that drilling, in 2016 and 17 and 18, you had back-to-back years of 15% default rates because of three things: the technological change, the change with respect to capital availability, and the pricing structure of the underlying commodity itself. And so as you draw that parallel to software, you have the same thing. You have this massive technological change called AI. It's going to affect the pricing structure, which is ARR, right? And capital is now drying up. Who will finance these companies going forward? And so I see those parallels. So when you go to the public equity market, there's no leverage really. You look at NASDAQ, S&P 500, the Russell 2000, look at the software companies in these industries, they have 0.5 turns of leverage, half of a turn of leverage. Not much leverage at all. You go to broadly syndicated loan market, 5.2 turns of leverage for a software company. Because when you come to the broadly syndicated loan market, the rating agencies and investors have discipline, and they say no more than 6 turns of leverage, or we can't let that loan go into a CLO, or if it does go into CLO, it's going to have a much lower credit rating. So where do all the highly leveraged broadly syndicated loans go to, or I should say direct loans go to? They go to the private credit market of direct lending, where they're 8, 9, 10 times leverage on software companies. And so what that leads you to is this. The public companies have really nice margins, generating free cash flow, and can defend the fort. In other words, creative destruction can make them a better company in an AI world. They have a really good fighting chance to do so. If you're 10 times leveraged or 8 times leveraged or even 6 times leveraged, then all your cash flow is going to debt service. You have no cash flow, no free cash flow to be able to reposition the company, make the investment you need to make to transition to an AI-first software business. So I think the default rates, now that the bed's been laid and there's no out, in the years 27 and 28, when a lot of these 20 and 21 and 22 deals come due, loans are 5 and 7 year loans. When these loans come due, there's no refinance capital available. And so there's a very big parallel, and I'm calling for a 15% default rate. I can't tell you if it's year 2027 or 2028, but it's coming, and it's unequivocally coming because the valuations have been reset lower, and anyone that's a lender today should be lending at 4 turns debt to EBITDA, not 6, not 10, and they should be getting paid a higher rate because it's a uncertain business to lend on.
By the way, before I get into why private credit has so much exposure here, what do you think of the public companies that have been crushed because of this narrative, but maybe aren't going to have their lunch eaten by AI? I mean,
I think there's some good value there.
Yeah.
And so you see the software industry itself has bottomed a couple weeks ago in terms of, or in the last couple weeks, in terms of valuation after a big trade-off. And so they're actually up off the lows. And those companies aren't levered, but also have to deal with transition. So on some of those companies, you're going to see, significantly higher prices because of the creative destruction will allow those companies to be transformed into an AI-first software. And some of those companies actually won't make it, and you'll see some losses. But you have all the upside, if you're buying an index of it, to offset your downside. And so I'm actually neutral to slightly constructive now on software. I'm not saying we've seen the bottom, but I think that I'm not so bearish now in the public equity markets for software because there's been this massive adjustment. We don't know who the winners or losers are yet, so it's hard to pick single names. But for an overall industry, I think there's been a massive adjustment, which offsets some of the uncertainty. In the broadly syndicated loan market, software names are off year to date around 11 to 12 points, and they're 5.2 times leveraged. So then you have to say to yourself, okay, if a broadly syndicated loan is off 11 to 12 points, then how much should a direct lending loan be if it has much more leverage to similar type companies? Less than 10, 11 points? About 10, 11 points? Or substantially more? I'm not going to answer that, but I think everyone has their own conclusion on that.
Why is private credit so exposed? And by the way, when we ask on my show, I anchor Bloomberg's Open Interest every weekday from 9 to 11.
Great show.
When we ask, most of the fund operators say, that's everybody else, right? We're not exposed.
So everyone's rearranging the furniture right now. Yeah. It's like rearranging the chairs on the deck, right? As the saying goes. And not software company. Oh, it's a healthcare company. That's software company. Oh, that's travel and leisure. That software company. That's an education company. No, they may support healthcare or education or travel and leisure. They're software companies. And so everyone's trying to re-rate or recategorize what the exposure is to say, I don't have that much software exposure. The simple fact is there's 3 numbers to remember: 3, 13, and 23. 3% of the high yield market is software. 13% of the broadly syndicated loan market is software. 23% of the direct lending loan marketplace is software. And so it has that exposure, regardless of where you want to put the chair on the deck. It has that exposure, 23%. Now, some managers have 26% or 32%. Some of them have 15%. Different managers had different, investment discipline. But why do you have 23% in that one industry sector when only 1% of private companies are software companies in this country? I don't know. I don't have an answer for you. We have 1% exposure to software, and it's a 4 turns debt to EBITDA, loan. So I can't tell you why it's 23%, other than it was a big gold rush. Everyone had convinced themselves that you can finance and put a lot of money out the door by financing a software company because they had nice margins and presumably good growth rates. Most of those growth rates haven't panned out, though. And so now you just have a much highly valued company, too highly valued company, with too much debt on it. And that's going through a technological transformation with a pricing transformation that we've yet to see, but is undoubtedly coming as you pay per seat or you pay per token, or the pricing structure starts to change.
So what happens now to private markets? And everybody's, especially this conference, talking about yesterday, Mark Rowan said, we're due for a correction in private markets. But obviously there are different businesses. Private equity is very different from private credit.
Yeah. So I think private markets are actually in pretty good shape. I think there's some pain out there. If you have a cockroach in your portfolio, people are going to want a company that committed fraud. That's an issue. I think that's very idiosyncratic and very rare. But
you're not worried about the tricolors, the first brands, the MFS?
I'm not worried about that being systemic at all. It's not like liar loans on the subprime housing market back during the GFC that polluted the banks. The banks don't have this exposure. It's not that broad. It's very, very isolated. There will undoubtedly be more as people start to put the microscope on all these companies and bring religion back to how they lend, and lend in a much more disciplined way. And so number one. Number two, I think away from software, because I think capital's really not available to lend to software companies right now today in the private markets, other than the current lender wanting to amend and extend their loans, pick that loan. But the new money coming in isn't going to come in at more than 4 or 5 turns of leverage, because that's where a highly leveraged company should be financed. And software is inherently a riskier business today. And so it should be financed not only with that lower leverage, but with a higher spread, because you have greater risk given the uncertainty. As it relates to the rest of the economy for now is doing pretty well. Our natural growth rate here in the United States is 1.8%, and we're growing at a faster rate than that. We'll have to see with how oil prices are going to impact that, but holding all things constant from what we know from the start of the year, $30 trillion GDP here in the United States. You grow at 2% a year, that's $600 billion a year. I had penciled in we're going to grow at $1 trillion this year. Much more, because the reindustrialization of America, because bringing the supply chain back, because of everything that's going on with data centers and building out those data centers, as well as the economy. We talk about the consumer being a K-shaped consumer. It's an E-shaped. Economy starts with the letter E, not with K. And the middle class, that big line in the E, is a pretty big cohort.
By the way, this is an important point that you're making, Bruce, and because it isn't what we hear every day on my show. People talk about the K-shaped economy all the time, the idea that the wealthiest, the top 10% are powering more than half of the economy, and that the lowest 50% is having a real problem. We see, I think we lost 70 or 80,000 manufacturing jobs in 2025, so I don't see the reindustrialization happening.
But let me just tell you, the E-economy, and I'm talking capital E on economy. And there's that 10-20% at the upper end that owns assets, that have good credit scores, that power a lot of the spending. Got it, check. And there's a lower 40% of the cohorts that have poor credit scores and are indebted and struggle and don't have much assets, certainly on a net basis after debt. But the middle 40% is the middle part of the E, and let me tell you about the middle part of the E. Wages have risen sufficiently high, with inflation having softened just a little bit, although it's ticking up now with energy. But it's the first time in years that wages have risen above inflation, so they've actually had a chance to accumulate wealth. And the average middle class in that 40% has $250,000 of net worth. So $500,000 of assets with $250,000 of debt for $250,000 of net worth, with a savings rate that's starting to improve marginally. And that part of the economy is actually doing well. And so we talk about the K because we talk about extremes. That's politics for you, and that's, you know, people, you know, glamorizing the, you know, the extremes. But there's a real E in the middle that people forget about that also powers the economy. It's a big part of this. It's not only the K-shaped economy for consumers that is an E, the K-shaped economy is also for companies. Growth companies versus companies that struggle, but there's a big middle class there of companies that do just fine, that represent mid-market companies. And so if you look at, you know, the, you know, Mag 7 this year, it's down a few percent on the year. Well, if you look at materials and industrials and energy companies, they're up 25% on the year. And so there's a big middle class of companies that we also think represents the economy. And we think with the economy doing fine in terms of growth, A, B, the big tax receipts coming in because of OBBA, you know, and what it means for, you know, an average taxpayer getting back $1,000 in the middle class, more than they had. It's more discretionary money, more savings. And so I think the consumer for now is fine. The big delta, the big change is oil. And I've run my internal model, and it's really instructive for markets, and I think for how we should think about it, if you want to hear it.
So I do, because you have talked to me before about you believe manufacturing is coming back to this economy, and you're bullish the economy, as we just heard. Now, with the war in Iran, we are seeing, you know, Brent crude spike from mid-60s to low 80s, and inflation is going to limit the amount of cuts the Fed can act on. I mean, how is that going to affect the economy and your outlook?
It's big. It's big. And so the key here is duration. Duration of how long this lasts and what's going on in the Strait. So let me frame it for you. 100 million barrels of oil get produced every year in this world, every day in this world. 100 million. And 20 million come through the Strait. And pretty soon, Qatar is going to have to shut off their oil and gas, more importantly, their gas manufacturing and production. And it's going to take a week to 2 weeks to shut it down. It'll take a week to 2 weeks to fire it back up, because if you can't ship it out on these big LNG tankers, then where can you put it? And they're starting to get to that point where can you put it? And that's true. That's true of oil. It's true of gas. And so Henry Hub in the United States has gone up 5% since the war began 4 days ago. But in South Korea, it's went up 75%, the price of gas. And the price of gas is up 50 to 60% in Europe, because you're very dependent on these shipping lanes. And so you got to be very careful what it means. So here's my model, and here's what you need to think about. $60 oil, we grow at 3% in the United States. I think it's a lock. I think it's probably, you know, the surprise is going to be the upside of that in terms of the growth expectations I have for this year. Take oil up $20. That's your magic number. It's for every dollar, but like I'll extrapolate for you. Take it up $20 to $80. I think growth rate goes to 8, from 3% to 2%. So you take 1% off at $80 oil. Now let's go to $100 oil. You're at 1% growth. Let's shave off 1%. 1% growth, which means you have not only inflation, as you mentioned, but lower economic activity. I'm calling that stagflation. You take oil, not for a spike, but sustain it there at $120 an oil, a barrel for oil, $120 for Brent, you're at zero growth. That's the trigger for a recession, $120 a barrel. That's what I believe, and I believe that's what the markets believe, although no one said it yet. That's a very simple model, and let's lock that in. $100 is 1% growth, 120, and the president knows this. And they want the war to be short, be over in a few weeks, to get that Strait open, to get oil pumping again, to get the economies of the world back on track, and having solved this problem that the U.S. has and that the West has with Iran. And if he can pull that off, that's legendary. If you can't pull that off, it's going to take much longer in terms of duration to stretch on for a really long time, then that's really a problem because it's going to eat into economic growth. And that changes the whole equation for what you expect in terms of, growth and financing and equity markets, and because it very much drives valuations.
Bruce, I'm seeing red flashes here, so I know that we're out of time, but I do want to get to the acronym that you coined on our television program this morning, which is HALO.
HALO.
This is, I guess, depending what happens in Iran, obviously, your investment thesis right now, and it stands for hard assets, low obsolescence. How do you come to that and expand on it?
Yeah, so, I mean, in asset-based lending, when you lend against aircraft or engines or cranes or turbines, and you have $300 million of collateral and you have a perfected interest in it, and you're making a $200 million loan, you have a $100 million margin of safety, and it's a mission critical asset to the company. So when we take engines and we lease them to Delta Airlines, that's a great credit. That's a great operator. And we're making a nice return because we secured these assets. It's hard assets, low obsolescence. Okay? And when you think about direct lending as well, the opposite of hard assets and low obsolescence is software.
And there's no software names that you like, by the way. There's, in terms of the debt, right? There's nothing that's fallen far enough that you're bargain hunting.
I think the shoe for financing has dropped, but I don't think the other shoe has fallen in terms of defaults and defining who the winners and losers are. It's too early to tell that. But I do know that they don't have free cash flow after debt service, most of these companies, and it's going to be very hard for them to reposition. And so the public companies are going to be the winners in that space, not necessarily the private equity companies. But again, private equity has all the upside, and so they're so good at what they do that they'll figure out how to reposition a lot of these companies to get those much higher multiples that can offset some of that downside. But back to direct lending, if you have a direct lending loan to a company that does, I don't know, sprinkler systems for commercial buildings or concrete with rebar, that's going to help power the reindustrialization of America. That's a very stable business to be in, and so we like those type of businesses, hard assets, hard to replicate, real economy assets that we can lend against, either their operating businesses when doing direct loans or hard asset lending when we're doing ABL.
Bruce, always a pleasure. Thank you so much for joining us.
Thank you, Matt.
Bruce Richards, Marathon Asset Management. Show, Bloomberg Open Interest, weekdays from 9 a.m. to 11 a.m. Thanks.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every Wednesday at noon Eastern, only on Bloomberg Television.
Please welcome to the stage Scott Nuttall, co-CEO at KKR, for a special simulcast of Bloomberg Deals with Danny Berger.
Thank you all so much for joining for this special edition of Bloomberg Deals here at
And we're good.
Scott, thanks to you as well for helping close out this excellent conference.
Thank you, Danny, for having me. Hi, everybody.
So as this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment, because we entered 2025 saying this was the year of private capital reemerging, of animal spirits, of deal making, and then April 2nd happens. It feels like we did the same thing over again in 2026, and then it's AI, credit fears, and now war to contend with. Scott, can 2026 still be the year of M&A, of deals, of private capital's year?
I think it can be. You're right. There's a bit of a deja vu element going on. We came into last year and this year with expectations capital markets would be strong, M&A environment would be robust, and it was last year for larger transactions. A lot of what we do, the $1 to $10 billion deals, was less robust. I think people were waiting a little bit to get into this year to start to sell some of their companies. It still could be the case that that's available. This is a moment in time We'll see how long we're here. It's far too early to call. As you know, the tariff concern last year lasted for a couple months, and the people processed it and started to move on. We'll see how long this lasts. This could have more duration to it, though.
Well, what happens if it does have more duration? And I should just say that KKR has been out in front with monetizations, but the industry as a whole is still experiencing that indigestion. What happens if it continues?
Well, I think you got to step back. The way we look at it is you got to go back in history a little bit, right? So we came out of the financial crisis as an alternative asset management industry. The whole space was roughly $3 trillion. Right, so we've seen growth now from $3 trillion, and that's excluding hedge funds, to about 15 from the course of 2010 to 2025. Okay, that sounds like a lot of growth, but it's about 11, 12% a year. And so we went through this period of time, 2010 through 2020, pretty benign environment, right? Rates were low, inflation was low, multiples were going up. We said to our firm, do not confuse a bull market with brains. Right? We saw a lot of growth during that period of time. And you're right, 2020 to 25, pandemic, wars, inflation, rates up, tariffs. Very different period of time. And so what's starting to happen is you're starting to see the decisions that people made over the last 5 to 10 years become more clear in terms of whether those were good decisions. Our industry periodically over-deploys. And that's what happened in 2021. People put a lot of money to work in 2021. And so to some extent what's happening now, and some of the noise I think you're hearing in the market, is some of those deals are now getting to their 5-year mark. They've got to refinance their capital structures. But not everybody's painted with the same brush. You know, this is a very US-centric dialogue so far. Sure. You know, for us, we have more than half of our investment professionals outside the United States. Right? We have learned these lessons, and I can say this with a lot of humility. We made the over-deployment mistake as a firm in 2006 and 2007. And so we learned, you got to be focused on linear deployment. It sounds boring, but if you have 5 years to invest money, do about 20% per year. It's a very low-tech chart to see how you're tracking. Don't over-deploy, don't under-deploy. Got to focus on portfolio construction, and critically, you got to be diversified. And there's nothing that kind of beats those 3 things. And what we found, I thought it used to just be my teenage sons, but it turns out everybody's an experiential learner. You know, people learn by doing. We learned these lessons a long time ago, and so I think where we're heading now is, you know, we've talked about K-shaped economy all the time. I think we're headed toward a K-shaped industry, where you're going to see a bunch of winners and some folks that have more lessons that they have to learn as they come out of this period of time.
But is everyone going to be like KKR, learn the lesson and go on, or is it a shakeout that's going to happen in this industry?
Far too soon to answer your question.
Okay.
I think there's going to be some consolidation. As sure as we're sitting here, there's some firms that will not be around. There's some firms that will do the apology tour and the apology fund. So the next fund will be 0.3 times the size of the last fund, but their investors will decide to give them another chance. How that breaks down, far too early to tell.
Is it a problem then, and I don't want to get into the complexities of war, but one of the outcomes of it might be that are currently learning the lesson to survive?
Well, I think we will see what will happen, and we're already hearing it from our limited partners and institutional investors in particular. They are consolidating their relationships with people that have been giving them money back and people that have been performing on a relative basis. We did spend better part of 10 to 15 years a little frustrated because we felt that we were making better decisions in terms of through cycle investing. That was not apparent when rising tide is lifting all boats. It is now far more apparent today than it was even a few years ago, and a few years from now will be even that much more the case, hence this K-shaped comment. So I think what's going to happen is you're just going to see increasing dispersion in results, and not everybody's going to be painted with the same brush. So for example, in January, we sold a software company for 4.5 times our money. On Monday, we did a block trade in the public markets for one of our public names in the US. We have multiple businesses all across Asia. It was a very active monetization year for us in Asia last year. The benefits of being global and diversified and being thoughtful about deployment pacing through cycle investing and portfolio construction are going to really matter. And then there's going to be the have-not bucket. And we'll see. We'll see how people learn. We'll see if their investors are prepared to give them a chance to come out of it. And so over time, some of those will do well, as we talked about, and some may not be around.
By the way, I mean, underlying all this, and this is kind of where we started, it feels like there are 4 simultaneous existential shocks and risks happening right now, whether it be how AI transforms our world, fears over credit, trade fears continue to crop up, and it's now war too. What is an investment committee like at KKR right now? There must just be so many risks that you're having to grapple with.
We're very calm. I think we're actually enjoying this period. Okay, so you got to focus on what you can control. Markets, actually, let's go back, further back. Human beings, and therefore markets, hate uncertainty, right? It's absolutely the case. And it's also the case that a number of people, most people that are investing seats for a long while, have PTSD from the financial crisis. And so everybody's trying to figure out what's going to trigger the next big downfall for the space, for you name it, for the economy, for the markets. We don't see a precondition for that as we sit here today.
By the way, so just meaning you would disagree with the Jamie Dimon comment, it looks like pre-2008 sort of environment.
Who knows? You need a lot of humility. That's not my job.
Sure.
Right? Our job is to invest for the long term and generate returns for the people that are counting on us. We need to think in 10, 15-year increments, right? So the investments we're making today, the companies we're financing today, people that refinance us out of those or buy those assets from us, they're going to be looking at years 10 and beyond. And when you kind of think in that way, oddly enough, it's easier to kind of get your head around what's year 10 look like than what week 10 looks like. And so what happens when you have volatility, it tends to be great for our business. And this is where people get a little confused. If you're a public market investor, because you invest, you think we do the same thing. It's a very different business. We have 118 billion of dry powder, right? And as we say to our teams, if you have 118 billion of cash in your pocket and nobody can take it away from you, when things get cheaper, that's called a good day, right? So to some extent, you kind of almost root for things to kind of get more reasonably valued, and then you can make some great investments. These tend to be very attractive vintage years for us, but I think we need to be really sober-minded about what's happening right now. S&P 500 is flat year to date.
Yeah.
It's up 18% last 12 months. Europe is up 6% year to date as we sit here. Asia's up 8%, even with the correction that we've seen in the last couple days. So it's not like the markets have traded off, and credit is just shrugging this whole thing off so far. And that's what we tend to watch more than equities.
Well, are you
credit.
surprised about that at all? That markets seem to be shrugging things off?
I think people are trying to assess, what does this really mean for the long term? And you have a challenge, right? Where's the money going to go? There's a lot of liquidity in the system. And so to the extent you'd asked me a week ago if we were going to invade Iran, or bomb Iran, what is that actually going to do to the markets? I'm sure most of us in this room would have been wrong. But in terms of how people are thinking about the long term, it is what it is. But for us, the equity market, we tend to think of as the more emotional friend you have that's a little Chicken Little in nature. And the credit market is the more sober-minded friend. When this friend gets nervous, that's when we get more nervous. We're watching this kind of move up, down, sideways so far. It's too soon to know.
I mean, that's one side, that there hasn't been a lot of reaction. Where the reaction has been is every single headline around private credit, whether it be redemptions picking up or just readership and viewership interest. We certainly see that on Bloomberg. Are you surprised about that reaction, about the reaction to private credit that just feels like there's so many eyeballs and such a microscope on it right now?
Well, it's a little bit to my PTSD from the financial crisis comment.
Yeah.
I think people are just looking for what is the next thing that is going to trigger something bad. And so I'm not surprised that it's getting focus. But also, let's keep in mind, right, the global capital markets are $300 trillion, about 50-50 debt equity. Fixed income's $150 trillion market. Direct lending, so when people say private credit, they're really talking direct lending, is $1.7 trillion of the 150. And so it's roughly 1%, a little bit more than 1% of the fixed income market. And then within that, this isn't a return thing. To get a fund down from an 8% return to 6%, you need to have a lot of defaults and very poor recoveries. And if you have that dynamic, I promise the last problem you're going to have is your private credit return being 5 or 6% versus 8%. You're going to have equities off a lot. You're going to have other issues in your portfolio. So it's less about returns. As ever, when you get in these moments, it's more a question of liquidity. And that's what people are anxious about.
Is that a fair anxiety to have about liquidity at this moment?
We don't see it. I mean, I think the vehicles themselves, forget whether the structure of these kind of private BDCs is going to work for the long term. That's not really the question. I think people know that it's private markets. It's actually in the name. The reason that you tend to have issues with the markets more broadly is you've got leverage on top of leverage in the system, duration mismatch across wide swaths of assets that get revealed. From what we see so far today, that's not the case, but there's a lot we don't know. And I think that's what the market's nervous about, back to the anxiety and uncertainty. And in the public markets, people sell first and ask questions second. And so we're kind of in this moment where people are nervous, and people that are nervous or panicking, they don't listen that well, and they're not often great at math in that moment. And so we're kind of in that moment in time right now. It's too early to call. Let's see.
Is it a problem, though, if fundamentals are sound, but you have this technical issue of redemptions and outflows? In other words, does something that become technical, is there a risk that it spills over to become a fundamental problem?
It would be, man-made in that instance, I would think. Sure. I think if people want to, kind of be very anxious and the markets more broadly trade off, could you come up with a scenario there's a wealth effect? But you would need such a big move in the markets. And I think one of the things we're seeing, there hasn't been a lot of new supply created in the capital markets. Part of the reason we haven't seen the credit markets move, there's not a lot of new supply getting created. There's actually supply being removed, and there's a lot of cash in the system. Same thing in equities. So it's a little about where's the money going to go? What else are you going to invest in? And we can sit on cash, sure. But in terms of if you want exposure to risk assets, people are looking at the market thus far as clearly and saying, okay, despite all the noise, this is pretty isolated. Software, AI, private credit, non-traded BDCs, very, very small part of the overall market in aggregate. The rest of the market's shrugging it off.
By the way, that idea that there's capital that needs to be put to work and there's limited supply, that's been pointed to as saying both credit and equity markets are mispriced. Would you agree to that as well? You're a close observer of credit markets, that there has been a little bit of skewing of valuations just because of the demand and lack of supply?
Oh, there's no question in credit in particular, spreads have been tight. Right there, it's back to the point. There's been capital, formation, but not enough product being created to absorb it. And so I think in the long term, I think we might look back on this period of time and saying this is healthy. This is a healthy rebalancing in terms of kind of spreads may move out a little bit. We'll see. Hasn't happened yet.
Right.
But if they move out a little bit, it'll be more back to where they were. Because remember, we're at kind of near all-time highs for most asset classes and more near all-time tights in credit spreads. And so people forget, not that long ago, last year the S&P went from 5,800 to 4,800. Now we're at 68, 6,900. A year later, the markets have moved up a lot. And when you have 3 years, we were talking about this morning with our partners, when you have 3 years in a row of 15+% return for the S&P, the next 5 years are pretty anemic in terms of equity returns. And you usually have a down year. We've had a great run in the equity markets and same in the credit markets. So taking a little air out of the balloon wouldn't be so bad. And for people looking to deploy capital, back to my point, volatility creates opportunity. So it's all about being ready.
Where's that opportunity right now? I know COVID, for example, when the market was frozen, KKR was one of the few that was out there to that point of linear deployment. In the volatility right now, where are you seeing those pockets that look attractive?
It hasn't really shown up in size as of yet. So you're right. COVID, we were doing daily partner calls because we wanted to be ready. And we put a lot of money to work. But there was literally a 1 or 2 week period where the leveraged loan markets globally were on sale. And then it all came back. So you've got to be ready in the moment. You can't say, I'm going to go study this for 3-4 weeks. It's probably going to be gone by then. So we haven't gone to daily partner calls yet.
Right. But
we're getting close to weekly. So we're moving, but it's all about being ready. And so what you got to do is you got to create your shopping lists. That's what we're focused on. If something gaps out enough, where do we want to buy so that you can move fast? that's our work right now.
Can we have a peek into your shopping list?
Nope.
What might be on it?
Nope, I'll tell you later. I'll tell you after the fact. How's that?
Okay, fair enough. Come on Bloomberg Deals and tell us when it does happen. One purchase that we know you did is of Arctos. Can you just walk us through the thinking on that? Sports, secondaries, what was the moment that you decided these are capabilities that we want to add onto our platform?
Sure. Well, really, it comes down to people. I mean, we're in a people business, right? It's just the marriage of capital and talent. And so we have known Ian Charles, the founder, for a long time, decade plus. Liked him a lot. Did a deal with him, actually, secondary sale off our balance sheet. That's how we met. And, you know, sometimes you meet somebody and say, wow, really capable, you know, would love to have him as part of our team. It was that kind of a moment. Sadly, he worked somewhere else at the time, but he left that place and then started Arctos in 2019. So it really started with that observation. He built this sports business with his partner, Doc O'Connor, and then a GP solutions business alongside. And so we started looking at what they were doing, and because of our relationship, we just were comparing notes. You know, they would call for advice, we'd call them, get their thoughts on the markets, that kind of thing. And it just kind of developed organically from there. We as a firm, the one thing we do not have is a secondaries business. We looked at buying several and decided we couldn't find anybody that fit with us. How's that? So Ian and his team, their background is in secondaries. So the way we looked at it, the sports asset class, highly attractive, not just the franchises themselves, but real estate, securitizing media rights, lots of opportunities around it. GP Solutions, which is providing financing and kind of business building help to firms that own have alternative asset management firms. That, as a business we know well, we've built our firm. And we cover 250 sponsors already through our direct lending and private credit business. So a lot of synergy there. And then they hadn't started building the secondaries business yet. So we looked at it as established business here, and then a big opportunity to build secondaries together. So that's how it happened.
Do you also have a shopping list for other pieces you'd want to add to the platform? Is there a sale among managers as well that, along with Arctos, you'd want to bring into the KKR fold?
M&A is hard in our business. It takes a long time. And for us, you know, it needs to kind of check a number of boxes. Asset class we're probably not already in any great size.
Right.
The team fit and culture fit have to be amazing. That was critical about Arctos, is the cultures are the same. And probably more permanency of capital. What you don't want to do is pay a big multiple for runoff capital that you have to replace. That's hard to find. Arctos, we bought a REIT platform in Japan. We bought our insurance company. So we've spent 13, 14 billion on acquisitions, but they're hard to find that have all of those attributes. So we're always looking, but I wouldn't say there's a long shot.
Is it industry-wide? Because there's been some talk of, are we going to start to see mega mergers? Do you think that consolidation will take in that form and you'll see a really dramatic shrinking of just the number of firms out there?
I think the mega merger between two alternatives firms is very hard.
Right.
You got overlapping LPs. You've got to figure out who's going to run the place. If you have overlapping businesses, probably a decent amount of negative synergies to think about. So I think you'll see more maybe BlackRock type acquisitions of alternatives players, and maybe players in different asset classes get together and create firms that have more diversity and kind of magnitude of overall AUM. But the two big firms getting together, never say never, but it strikes me as unlikely.
Do you think, though, that given what you're talking about, moving to alternative managers, only about a minute here, but that the landscape will just look very different in 5 years' time?
I think we've gone from 3 trillion to 15 trillion during a period of time where it was, for most of that, everything was going your way. I think we are going to see this space continue to adjust. I think, we'll have fewer players 5 to 10 years from now, but I don't think you're going to see a dramatic difference. I think you'll see it around the edges, and you'll see the big continue to get bigger.
All right, Scott, we're going to have to leave it there. Thank you so much for closing us out and joining us today. Everyone, please join me in thanking Scott Nuttall of KKR. Thank you to everyone for being here, for being such a great audience. We hope you all enjoyed all of the conversations over the past 2 days. You can head to Bloomberg Live's YouTube channel or to Bloomberg.com if you want to rewatch any of these conversations. I also want to give a quick thank you to our wonderful sponsors over the past 2 days. It is our title sponsor, Invesco and the Qs, QQQ.
Our Knowledge sponsor Marsh as well. Our supporting sponsors, Allspring Global Investments, Deutsche Bank Wealth Management, Harborview Equity Partners, Moody's, and Salesforce as well. Very thankful for all of our sponsors. If you don't need to head off, please join us downstairs. We have a lunch. We have a networking lunch downstairs. As a matter of fact, it's out these doors. Make a right. And we adored having you all here. Thank you, and have a wonderful day.
Where you going, my brown-eyed son? You used to crawl, but now you run. You started off on a road half dark, and the river curled into a question mark. We sleep on diamond beaches, dear.